keep an eye out for Tracy. That's the last person we're looking for the panel before we get started.
Craig, where are you calling from?
Well, I'm located generally in Chicago, but given all that's going on, we're out in Steamboat, Colorado. So I'd love to be out here skiing, but they closed the ski hills, so it still can play in the snow, though. It would have been a tough morning to get to the office. There's a good 8 or 9 inches out there this morning.
Oh, really?
I'm thinking powder day, but it's not happening.
Not happening. Not even with the face mask.
Not even with a face mask. I guess I could walk up the hill. I could. I'm sure there are locals doing that.
Okay. So John is going to join us.
He's on the next panel, so he will be. He's just tuned in. Benny, do you want to try sharing your screen real quick, just so we can do a quick tech check?
Sure. Let's do that. You see it?
Yep, you're all set. Great. And if you can just disengage, we'll pull it back to. Get started in a couple minutes. Thanks everyone for tuning in. I guess while we wait, I can take people through how to get to their one-on-one meetings this afternoon. So if you've logged into Ensemble, this is what you'll see. You can either click on the virtual discovery day up here. There's the one-to-one meetings, event lobby, and watch content and panels. Obviously the content and panels is this morning, but this afternoon you'll be able to check into your one-on-one meeting schedules. The meeting links will be populated on the right, and you'll be able to take everyone through those. And if you have any questions, please add them to the chat. I've got the chat going on the right. Let me see. Todd, any luck finding Tracy?
No, Keith just emailed her.
Okay. And for some of the data providers that have tuned in, we have kind of a neat add-on that we're going to really be rolling out for the next event, which once a data buyer comes in and requests a meeting, they'll be able to ask what topics do you want the data provider to focus on? Are there any specific sectors or company tickers you want to cover in the meeting? They'll submit that, and then prior to the next event, we'll try to give you a little more feedback, just so that you can kind of come armed to the one-on-one meetings with, kind of the right data and tools and everything entered. I'd say on the data buyer side, it's been exciting to see how many of the data buyers have logged in and actually used either the sandboxes or have started playing around with the exploration kits. The data providers that have actually put on data onto the system through Ensemble, we saw probably a 2 or 3 to 1 increase in the number of requests. So I think that's really a testament to data now, that people out there, especially in the COVID world, are really needing access to the data immediately, not something that they're going to get in 3 to 6 months. So that's why we're really excited that the traction that Ensemble's getting and the ability for people to get actionable insights. So I guess, Todd, why don't you keep an eye out? I think what we'll do is we'll probably get going just because we want to keep things on schedule. One thing for the people that have logged in, if you could just look on the chats button, I guess it's on the side. If you see that area, if you could just do a tech check, tell us where you're dialing in from, or hopefully zooming in from. It'd be great to kind of understand where people are coming from. I imagine 99% are probably working from home, but it'd be great to kind of hear where everyone is. As we see those coming in, we should be able to check on some of that. Let's see. Great. Okay, well, I guess first of all, thanks everyone for tuning in. I know it's a volatile market, but I think the current downturn is probably fundamentally different than anything we've seen in the past. We're trying to use data to help figure out what some of those structural changes might be, whether it's more localization of supply chains, more companies may opt to work from home. They're going to focus more on digital channels. And I think one of the interesting things about this environment is that you have, unlike other ones like the Great Depression or even other recessions, I think this one, you'll kind of know when we are coming to an endpoint, and that's, when a vaccine is available or a cure. So I think using data, especially in the news categories, can be important. So Benny will touch on that in a little bit. And I really believe that, this can be a really defining moment for alternative data. We're going to be coming into this earnings season and not seeing a lot of information or even guidance coming out of companies. So being able to find these alternative data sources is going to be more meaningful than ever. I think one of the things that surprised me is just the volatility of the market and what's happening, which is why we kind of chose this title for a panel, because I remember my days of kind of being a portfolio manager, and I don't know how people do it these days with the massive swings and the volatility. So I think, in times like this, having access to data sets like SpiderRock, Camgen, and LexisNexis really can give you an advantage that you need in markets like this. So today I'm joined by Craig from SpiderRock and Benny from Cognovi. Tracy will be joining us hopefully soon. But what I thought I might do is maybe turn it over to Craig first to take us through a little bit about SpiderRock, his company, and kind of the volatility aspect of the market. So if we could, I'm going to stop share and turn it over to Craig to get going.
All right. Hey, morning, Tim. Morning, everybody. And I think
Tracy did join.
Oh, Tracy did join. I see you there.
So maybe just give a background on yourself and the company, and then we'll go to Benny, and then we'll kick off with Tracy.
Okay, awesome. So SpiderRock, my background, I'm the chief operating officer of SpiderRock. SpiderRock was born about 14 years ago, one of the co-founders, and SpiderRock's got several businesses. The one that I really have a lot of passion for is our data and analytics. So we've been working very hard to build that. I think data is really important, as you said, going forward, and immediate access to it. And that's what we're trying to do at SpiderRock, and we're trying to do that with the kind of options data and analytics so that people can use that. So I'll talk more later about the specific data, but that's an introduction.
Great. Benny?
Yeah, good morning, everyone. My name is Benny Gradwall. I'm the CEO and co-founder of Cognovi Labs. We've been around for about 3.5 years, and we really do only one thing. We focus on the human behavior. How do people make decisions, whether you're a consumer, whether you're an electorate, whether you're the public in general. And we look at it from two directions. First of all, how do we quantify how people make decisions? What does that mean for their next action? So it provides you predictive insights, and that's why We're part of BattleFin, we're part of the alternative data community. But then with corporations, we also provide specific phrases and issues by which companies can actually change their behavior. So it's all around the human decision-making process.
Great. Tracy?
I'm sorry about the technical difficulties. I'm with LexisNexis, and I'm the director of Data as a Service, which is our data arm of the company. We are a content aggregator, and we focus mostly on news and business information coming in from around the globe. And so we have both archival as well as data feeds to work in this space as well as others. So we have both products that come in for building your own product as well as for internal use.
Great. And I guess if you could start off, Tracy, maybe we'll have you take the screen share first. And, you know, maybe give us an idea of where your data is pulled from, you know, and even some of the title of this, this panel is volatility, and, you know, looking at where the data comes from, how it can help investors or corporations better understand prior pandemics, or even, you know, news flow and how that's evolved. That might be a great lead in to understand.
Okay, sure. So we've been harvesting or ingesting data from global publishers for over 40 years. So we have a pretty vast archive of content in multiple languages that spans over, I think, enough timeframes that help with models. So if we, what we've been doing in the past few weeks is working with different entities that have wanted to make sure they had time capsule data around the 2018 Ebola, and then of course H1N1, which was in 2009. And obviously we have enough data to give them access and that variety of what's coming in, so they can look at it from a global perspective as well as a local. So that's what we've been working on for the last, I would say, month, is just getting access to entities, whether it's universities that are newspapers, it spans who wants the data right now. But that's pretty much what we've been seeing, is the ability to be able to identify times in the past and look 3 to 4 months before to build those triggers or whatever those might be, look during, and then obviously resiliency has become truly much more impactful lately. And I've been working on resiliency projects for a long time, mainly with the Rockefeller Foundation and others, with this whole idea of resilient cities. So taking that concept and applying that then to news within the markets or anywhere else is pretty interesting, just to see what is the typical scale, or what is that bounce back, I guess would be the best way to explain it. So that's pretty much where we've focused lately. And we just feel that we've got enough information, and we even made a quick graph looking at our news, and we're monitoring it on the volatility. Well, I don't want to use that word too cavalier, but we have 2 different things running, and I can share it with you if you want to see it. Let me share my screen real quick. There we go. So what we've done here is just look at the news in terms of adaptive risk. So we're looking at PESTLE, which is political, economic, societal, technological, legal, and environmental. And we've just what's been mentioned in the news in terms of which one are they focusing on. And as you can see, economic is the biggest focus in the news in the last 10, 15 days or over the last month, and that would make sense. And obviously political, that seems to have, our definition of political politics is not really paying as much a role in the focus of what's going on in terms of influence and risk. And then we've carved it out where we can also tell you where the biggest impacts are coming, the biggest risk impacts. And then what's interesting is, if you look at this, we've also looked at what societal risks are dominating in the media. And obviously wages and salaries are clearly what's the focus. And then if you look here, what else is trending is layoffs. So this is just something we've done quickly that we've made public to everyone. And you can even embed this chart, and it's dynamic. So as we're feeding more news, if you embed this on your website, it too will change as the time changes. What's kind of cool to see is we've been tracking the news and then the S&P index. Now, again, we're not as savvy when it comes to volatility or trending in the markets, but this is a very simple graph. But you'll see that I would say volatility pretty standard until about, I don't know, March 8th or 9th or 10th is when it started to pick up. And then you see how short the spikes are. So the news, as the news is highly negative, the stocks go down and vice versa. So it's really kind of cool, but you see the short spans, it becomes pretty spiked. It's up and down almost on a daily basis. And what that is March 10th is pretty much when we announced Vice President would be in charge of our own coronavirus reaction team. That's when I would say the US kind of said, okay, this is real. And this is when the markets reacted to that. And this is when it was almost to the day of the US saying, okay, it's not what we thought it was, it's something else. And then they started the daily press briefings. And that's what I think you're seeing here is the reaction to the news, the briefings, and then the rebuttal of those briefings, and then the stocks themselves. So it's kind of interesting. So we've done little things like this. And then again, we've got some others, but these are available to anyone who wants to put them on their site in an effort to keep people informed on what's going on and what the trends are. And you know, just we tried to do something that was a little bit useful during this risk time. So I'm gonna stop sharing there, but that's just one simple thing we've done, but that's with today's news. So the interesting thing is that we're able to use our archive to help people build models or look at analysis, but then we have the ongoing API feed where you can then apply what you've learned and establish those triggers or say the predictive modeling that you want to do.
Great. Yeah, and I'll save some of my questions till we get through Craig and Benny. But you know, one thing that pops to my mind is, you know, okay, if there's a second wave, how can we use this to, you know, be ahead of the curve, things like that. But why don't we move on to Craig first, and then we'll and then Benny, and then we'll come back to that. So Craig, if you can screen share and unmute, that'd be great.
All right, let's see if we can do this without causing major problems. All right, so I'm gonna start just with a screen share. Let's see. And all right, does that work for you?
Yes.
Okay, good. Awesome. So SpiderRock Data Analytics, we talked from an introduction standpoint a minute ago. And I guess I deal in sort of the world of options data. So actually the real volatility data in terms of measuring the volatility of the market. And just, it was interesting, you know, when we prepped in here to look at Tracy's chart in terms of how the news is popping back and forth, and just sort of now overlay that with, you know, what the markets are doing. She has the S&P market in there, which here is the gray line, right? And then here's the CBOE VIX index. Sometimes people would call it, talk about it as a fear gauge. In my world, I guess I agree with that, but volatility is really the measure of uncertainty. So the more uncertainty we have, the higher the VIX goes. And so this is uncertainty about where stocks are going. And this chart just sort of outlines, you know, the big events we had, the big moves up, the big moves down, and, you know, generates lots of data from a volatility standpoint. One of the things we talked about briefly in our prep was sort of the volatility of volatility in 2008 versus now, and you know, what might be different and what's the same. And I started to do a bunch of analysis of that and decided that there were too many factors to put out there. But I did put a chart together that just showed this is volatility in 2008, and this is what the volatility of volatility looked like. And you can see October being this big period here where we had the, you know, really high volatility. That if you look at our current crisis, the big spike period and I know the VIX hit a new high in March here around 82, which was slightly higher than 2008. But, that we were much quieter coming into this period, obviously, and going forward. So now to just talk a little bit about volatility data in what we do more specifically. So we're collecting lots of volatility analytics. And we believe that those volatility analytics can tell us a lot about other parts of the market. They can tell us a lot about how the overall market perception is changing at a given time, and give us a lot of information. Volatility traders use this to trade volatility, but from an alternative data standpoint, there's a lot of information in the wisdom of the market that's in these statistics and in this. And I just pulled out a couple to talk about them today. One is just measuring the absolute measure of at the money volatility. So essentially at the money volatility curve, looking out, this is 3 months forward. So this is implied. This is what the market thinks 3 months from now will look like. And as you can see, just the absolute levels of volatility by sector coming into this crisis, we were, it was euphoria, right? We were at market highs, things were going great. Crisis starts to hit, and not only can you see the escalation in the volatility, you see a huge spread in what's happening to different industries. So the volatility in energy, obviously, because of what's going on in OPEC, runs much higher than that in healthcare. So, and that this pattern here now in this regime is actually different than this pattern in mix down here. So this is just types of information or features you could pull out and use volatility data. A second one that we looked at, just a second simple one, volatility traders will talk about skew. In a simple sense, skew is kind of the imbalance between the demand for puts and the demand for calls. So here, as you can see, coming into the crisis, skew is kind of running flat and normal. And, as the crisis hits, the demand for puts goes up extremely, goes up really high. But interestingly here, about the 15th of March, and we're in the middle of crisis, all of a sudden you see a twist, and the skew twists and starts to turn the other way, and actually starts to predict that the market has started to settle out. And as you can see, the demand for calls in the skew shifts and starts to move the other way. So these are just two examples of types of things you can do with this kind of volatility data. And that's what we do. We try to make access to this easy and make it easy for people to use through places like BattleFin.
Great. And just one thing for the audience, I know if these charts are small, just through the viewing, we'll have access to the slides afterwards, so we can send those around too if people want to dive in. Great. And one that question that comes to me now, but we'll hold off till after, Craig, is interesting. Did you pull any similarities or any things out from the 2008, 2001, which you kind of highlighted a little bit, but two, what's it looking like for earnings season? We're in April. Are you guys seeing anything or hearing anything on that front? But what we'll do is we'll noodle on that and we'll come back. I'll turn it over to Benny. Benny, if you can unmute and share your screen, that would be great.
All right. Let me see. Can you guys see my screen?
Yep.
It should be large. So I'm going to go between slides and the actual application so you can get a little bit of a feel. So look, we are very emotional, correct? There's a lot of anxiety, mental health issues, stress during the pandemic. I don't have to tell you that, but what's really interesting is that even outside of a pandemic, in usual times, 70 to 90% of decisions are based on emotion. So whether we go out and buy sneakers at Adidas or Nike or travel American or United, usually those decisions are made by the subconscious mind based on emotions. And we have a couple of Nobel Prizes to show for that. Danny Kahneman, Richard Taylor in terms of behavioral economics, behavioral physics, behavioral finance. So yes, it's very evident that during the crisis, the the stress level has gone up, but the truth is we're always emotional. And so let me show you how we are using our technology, which is really going in, understands free-flowing conversations and extracts that emotionality and creates behavioral anxiety, panic scores out of that. I want to show you first what we're doing around the pandemic index, and then tell you how that translates into actual stock suggestions. So can you see my dashboard?
Yeah.
Okay, so we have a dashboard. It's freely available on our website. It's called at cognovilabs.com. And what it does is it really measures the anxiety and panic level around the coronavirus or specific topics, whether it's health related, shopping related, finance related, and so on. What you can do is you can look at it. You can change the time, the selection of the time. If you want to do that, you can aggregate it differently. Let me go back and go first to the overall pandemic in a second. Every time you do a search, it does it in real time. So let's start with the overall pandemic. You see on the left that the panic score, which goes from 0 to 100, is at 61 right now. Here in the US, you see the map. If you scroll down, you see the panic index over time. And at the bottom, you see what we call the awareness, which is the level of chatter. And what's interesting is that, yes, we know that the chatter has gone up into the millions in terms of social media posts and Twitter and newspapers, articles. But in fact, the conversation already started at the end of January when we got the first set of signals. And if you look at the top, you see a huge spike on the panic index. That was the first signal in mid-January, and company-specific signals actually at the end of January. On the right, you see the actual emotions which are being extracted. We extract six primary emotion of joy, anger, disgust, fear, sadness, and surprise, and then translate that into behavioral signals as I mentioned, the panic score. You can do that at various levels. You can say, okay, I'm interested really in the stock market and employment or paying bills. Let me show you, going back to where we are today, quickly. What are the paying bills issues? Well, we are, I actually wanted to show you the global map. So on the global map, you can see what the bills issue are. By the way, we have a word cloud similar to what Tracy has shown before. And it extracts the key phrases which are being discussed out of emotional conversation. And so let me go down. Paying bills is an issue. It hasn't been an issue globally, but if you go and dig into the US, you will see that there are bigger issues there. Let me go back. And by the way, feel free to play around in real time and test it out. What I think is interesting is not just how it captures the emotionality in the market from a macro point of view, but how does that translate into capital markets and how does it translate to actual companies and stocks? And so let me show you what we're doing with the same data, but at a company level. So if you think about not just conversation around coronavirus, but you think about conversation around companies, consumer companies, and we cover all the consumer stocks in the S&P 500 and the Russell 1000, you can look at the conversations as they're happening. And the first thing we do is something similar to what Stacy has shown, that the amount of conversations or the outlier of enhanced conversations, how they have evolved over the last several months. And you see there is clearly what we call the alerts, or company alerts. We usually had 3-4 company alerts a day on the 160 companies. They really have started spiking up sometimes in February and then in March. In addition, however, to just counting the number of events, we tell you whether that event could change consumer behavior, whether it's what we call a high impact event, medium or low impact. So if it's a low impact, that means that, yes, people talk about the company, about those issues, but they don't really care. They will not change behavior. If it's a high impact, yes, the emotionality is there to actually change behavior. And what you see is that not just the number of conversations have gone up or the outliers where there's a lot of conversation, but actually the emotionality has gone up. And I'm overlaying that bar chart with not the VIX, because the panel's conversation is around the volatility of the volatility. So I took the standard deviation around the VIX on a 6-day moving average, and you see that it really reflects the anxiety in the market. So what do you do with that? Well, if you go to the ensemble and the sandbox and the exploration kit, you will see that we provide daily data going back 6 years on all those 160 companies. And we wrote a simple white paper article in October. It's available at BattleFin. You can read it. And what it does is it exactly explains why our data captures the behavior and the emotions of a consumer and how they're going to act, but also how to develop a specific trading strategy. If you had done that, you would have seen that over the last 3 months, that trading strategy on a long short basis has done quite phenomenal. While the market has been down about 20% in the first quarter, our illustrative strategy has actually been up about 30%. So clearly the data which captures the emotionality behind people's decision-making is highly predictive.
Great, thanks, Benny. And we only have about 4 minutes left in this panel. It went by a lot faster than expected. I'm going to jump to the Q&A just so that those get answered. One other idea, as you guys move into some of your meetings this afternoon, I do encourage you to have the different providers take you through an exploration kit. These are built inside of Ensemble. They leverage our partner Refinitive's fundamental and reference data. You can actually work with the data provider to try to answer some of these questions. So the first question, which is from Tracy, or for Tracy, as the team is tracking news and associating to company word cloud, what is driving the cloud, and do you believe it could be used to ID recovery leaders and laggards? So, Tracy, I think you're on mute, so.
You're glad.
That's all you have to say about that one.
So I do, matter of fact, that's interesting. So we do, in fact, we leverage our smart indexing, which is a taxonomy that we've built over our research system, because obviously LexisNexis from the outset has been a research tool, user interface. So over the years, we've obviously collected data and enriched that data feed with identifiers such as tickers, the companies. So our word cloud, when we look at the articles, we're not just saying, okay, IBM or whomever was mentioned in it, but even if the entire article was about Watson, we would have identified that article ultimately was about the company IBM. So we've tried to make it very definitive and exact. So I do believe that you could use both a lot of our enrichments in an effort to identify companies in recovery or laggards, just by also using some of our industry tags as well, or our topic tags. So there's a couple of different ways that we could work with whoever the entity is, but we have those in the schemas and we talk about the enrichments. And I think those enrichments help identify those buckets. But again, I always kind of recommend too, we have a sentiment score. I think it's a great idea to use the sentiment enrichment as a baseline to test your own sentiment algorithm or models that you're building, not to rely on those. So I think sometimes our enrichments are usually used as a way to kind of baseline and understand, am I doing this correctly? So I think that using those enrichments would help wrangle the data quicker and allow you to make decisions based on those enrichments as opposed to just doing text mining.
Great. 1 minute left, Benny, so hopefully you've seen the question, but Cognovi, have you seen a correlation with public emotions bleeding over to the VIX? Do you believe that decision makers and investors can leverage public panic in a recovery phase, maybe a relief index versus a panic index?
Yes, so Tim, the answer to the first question is yes, it does impact the VIX, it impacts the overall market volatility. In terms of the second one, absolutely. I mean, the same way, it's important to look at the high impact event, and when people are emotionally engaged, it's as important to look when they don't care. And when we start seeing that the consumer, the public in general, stops caring about social distancing or is less concerned about the mental health issue or the lack of ventilators and so on, that will tell you whether there is a turning point in terms of the pandemic.
Great, and I hope people are going to be able to join for the one-on-ones. A couple, we did the pre-panel calls, and I thought, even some of the stuff Spider Rock was talking about and Craig about what's going on with earnings. Their data is on Ensemble, same with Cognovi, LexisNexis is onboarding. So during your one-on-ones, please ask them to talk about exploration kits, what they can build, and how they can really give you insights into their data. I want to thank you guys for joining today. If anyone hasn't requested a meeting or wants to meet with one of the different panelists now, please just email info@battlefin.com and we'll set that up. Thank you to the panelists, and we'll get ready for the next panel. Thank you, guys.
Thanks, Tim.
While we transition, if everyone could just put in the chat kind of where they're dialing in or zooming in from, if you hadn't, that'd be great just to kind of hear where people are joining from, and we'll transition to the next panel. And I will hand that over to Todd, who can start that process. Where are my meeting controls?
You want the first poll?
Yeah, sure. While we transition, we'll put a poll on. Everyone can check their screen. It should pop up when you launch that. And it is, have you been forced to cut your own hair? So this is one that near dear to one of my business partners and I, because we had a challenge and our kids were tasked with doing that. So I won't show you Tom's haircut because it's pretty gruesome, but anyways, hopefully the transition is over. I wanted to introduce John Najarian, who a lot of you know from CNBC, and Sean Muller, who's the CEO of iSpot. So take it away, John.
Great. Are we up and running here, Tim? You're seeing me okay?
Yep, you're great.
Okay. Thank you very much, Todd. Folks, it's my pleasure to be here. I'm a big fan of alternative data. I know exactly what Benny and the previous panel are doing over there at Cognovi, and I think it's great stuff. And I've seen so many interesting alternative data providers through BattleFin, and I use a lot of that data when I'm making trades now. And I'm sure a lot of the audience tuning in because they want to figure out, if they're not already using alternative data, how they can use it. So Tim, Mark, everybody involved with BattleFin, tip of the hat to you guys. As far as this particular panel, as you see that handsome guy on the right, that's Sean Muller. Sean is the CEO and founder of iSpot TV. I think you're going to have a pretty interesting half hour with us as we kind of talk about how these guys are truly disrupting exactly how people interact with advertisement and what's on television and so forth. Because as opposed to some of the legacy forms of finding out exactly what we're watching when we're on TV or when we're going through either TV, cable, over the top, and so forth on the net. A lot of us, certainly I was surprised to find some of the things that Sean really opened up for me, as far as, for instance, that every smart TV is an ISP, that it's able to be identified, and through a partnership that iSpot TV has, not just with New Star and not just with fantastic deals they've done, for instance, with TiVo or anything else, but through a lot of the embedded chips that are in these smart TVs, they're able to give us much deeper and richer data about what's going on. So with that said, please let me introduce Sean Muller. He is, again, the CEO and founder of iSpot TV. And when you guys see what the real-time dashboard looks like, instead of having to wait weeks or even longer, perhaps months, to find out how various programs or how various advertisements did on television. I think it really might give you some insight into which products, and it's not just, by the way, disruptor products. So let me throw that out, Sean, as one of the first things. It's not just disruptors that are basically using your iSpot TV. It's also Fortune 100 companies.
Yeah, absolutely. Good morning, John. Good to see you. It's
Good morning, Sean.
it's bright and early here in Seattle.
I'm sure.
But yeah, thank you for that intro, John. Really, as you've stated, iSpot is highly focused on modernizing TV ad measurement. It's an arena that really needed to be modernized. We started 8 years ago. In fact, today is our 8th birthday.
Yeah, I forgot to say that. Happy birthday, Sean.
Thank you.
You and the team.
Thank you. But yeah, we've really been focused on modernizing TV ad measurement first by bringing real-time data into the market, into a market that really had no real-time data. You had to wait 4 to 8 weeks before you got any measurement, any information back. It would be akin to having to wait 4 to 8 weeks for stock quotes, right? It's like
Right.
like today, it's like unheard of. So we really brought real-time measurement into the marketplace. We brought a lot of granularity. The old system was using a panel of 30,000 households. John, as you mentioned, we sit in smart TVs. We sit in 14 million smart television sets, and we were the first company to commercialize smart TV data in a measurement application. We started doing that 5 years ago. And really just evolving the types of measurements that occur on television. Historically, it's been all about audience measurement, and we've really brought audience plus outcome based measurement to the marketplace. But what, and John, to your point, yeah, we've had a lot of disruptor brands that have adopted us early on. But today we have about 40% of the Fortune 100, as well as even more mature organizations are realizing the value of quicker, faster measurement and the ability to move quicker, make decisions quicker and smarter on TV. And of course, we have a lot of, most of our businesses with brands and networks, but we have a lot of funds that use our data as well as interesting signals in terms of brands and media companies and networks.
Sean, why did you guys decide to jump in and disrupt this particular industry? Was it because with technology that you guys developed, you'd be able to basically do just what you said, deliver in real time rather than that long lag time, so that advertisers really could get a better handle on the money that they spent and how well it was being utilized in whatever medium they were advertising?
Yeah, exactly. I mean, it originally started even with a simpler idea. I mean, we were just dumbfounded that back in 2012, the $70 billion TV ad market and industry literally had no information on the internet about it. You could not find even the ads themselves or any information about who's spending what and where. And that's when we realized that the reason it wasn't on the internet is because that data just simply didn't exist. And so we set out, we knew there was a need here to just improve the measurement system in television.
Well, maybe, I mean, I think a lot of folks are going to wonder, okay, if there's 30,000 Nielsen boxes or whatever, and the other metrics that are, you know, sort of the old way of doing this, how did you guys get into 14 million homes? I mean, that's, how did all of a sudden you get, I know it didn't happen all at once, but like you say, you've been measuring smart TV viewing and so forth for over 5 years. How'd that happen?
Yeah, so actually before we started getting measuring smart TVs, the way it started is we built software that could automatically catalog every ad on television, track its airing schedules on TV, and estimate its spend. That was really the foundation of everything. And then a little over 5 years ago, we got to know William Wang, the CEO of Vizio, the TV maker Vizio. And we started learning that there was software embedded into the chips that can actually recognize what was on the screen. So we did a deal, we did an exclusive deal with Vizio 5 years ago to basically access their entire footprint against our ad catalog. So every one of our ads can be detected across this huge footprint of 14 million TVs all across the US. And then we built that into a real-time a measurement system that now not only allows us to measure audiences in a much more granular way for both linear and streaming television, but also allows us to connect all this to outcomes.
Right. So folks, if you're just learning about iSpot TV right now, you're finding out that there's a company, iSpot, that actually can go out there and tell you what these 14 million TVs have on, how long they watched it, when the channels switched and so forth. Not just like with a people meter like in the old days, Sean, which is something that, you know, I thought was exactly what advertisers would have demanded as soon as this technology was out there. Because
Yeah.
why would you want to wait to see what kind of that ad spend to see if it really was working? This way, you know, if that ad, number one, if it's popular, other than just that Super Bowl sort of, yeah, everybody throws a several $1 million ad up on the screen and for 30 seconds. And I think this is a better use, especially for the disruptors that don't have that Fortune 100 money. But then again, all those Fortune 100 companies are saying, I wonder if we're really being sort of gamed by whoever we're advertising with if we're not paying attention to this data.
Absolutely.
Can you comment a little bit on how financial companies are using the data, Sean? You know, in other words, since I'm a trader and one of the draws for me to alternative data and to iSpot was, okay, how do I use this to make money with what I'm seeing from this data? Can you give us a little insight into, maybe without using names, how some of the financial firms are using this data?
Yeah, you bet. A lot of the funds are taking our data via our API. We have a real-time API, and they're inputting basically spend data and real-time information about different brands and which products they're advertising and how much they're spending, as well as media companies. And they're really just using this as another input, another signal into their models. Because as you'll see here in an example I have coming up, it can be an indicator of how much a company spends on marketing today and on what products is definitely a strong indicator for future sales and performance.
All right, well, let's dive into some of the slides then, because I
All
know
right.
on one of them you have a poll question for us.
We do. We got some
Actually, on two of them.
That's right. We got 2 poll questions. Yeah, let's dive in. What we wanted to do today is actually use some of our real-time data and just take everybody through what is the pandemic's impact on the TV ad market, on viewership and on the ad market itself. So you guys can see my screen, I presume. Yep.
Yeah, you're looking great.
Yes,
Yep.
sir.
Okay, awesome. So let's start with just some high-level trends. We all know that TV viewership is up, but it's actually pretty incredible that it is up, given that pretty much sports has been all but eliminated from the face of TV. So what this is showing you, it's actually looking at the ad impressions on television year to date. So this is showing you that because of the overall increase in viewership, there is actually 51 billion more ad impressions on TV year to date compared to last year. So this is really incredible when you think about it, but this stat is misleading, right? Because if you think of viewership is up, oh, the TV ad market must be doing great. It must be doing awesome, but it's actually quite the opposite, because really what's happening is all the high value inventory, all the high value CPMs really in sports have all gone away. And this really drives home what's going on with sports. So what you're seeing here is spending in sports on television since March 12th, which is kind of about the date that the country was pretty much shut down, this is through yesterday. and it's comparing it to the same period a year ago. I mean, and this is pretty astounding, right? I mean, obviously March Madness was all but eliminated this year. So that's a drop in 99%. NBA gone, drop in 98%. And you can see some of these revenue numbers from 2019. You're talking 1.1 billion in ad sales for March Madness, 141 million in ad sales for NBA. You've got golf that's all but eliminated. Oh, and by the way, I just remembered we do have a poll on this one. If we could put that up, we'd love to hear from you guys and see which one of these sports you guys miss watching the most on television, if any.
I'm sure that the NCAA and golf, especially with the Masters being right here. I hear it's going to be, Tim. I think I heard it's going to be out in I think November now. They're talking about for the Masters. But anyway, sorry to interrupt, Sean.
Yeah, no, it's crazy. And they're talking about playing baseball in empty stadiums now, and it's just total chaos. And I think what's really going to indicate whether the market bounces back or not is NFL. So I think if NFL gets delayed, that's going to be a problem. But the bright spot here, if we are looking for a bright spot, which of course we are, horse racing is up, and so is wrestling. So if you're looking for something to watch, that's what we see. So we know sports is gone, but news networks are seeing huge spikes in viewership, right? So you're looking at the traditional news networks; they're up big. You can see here CNN, Fox News, MSNBC, CNBC, or they're all up big. The financial news networks are also up really big. You can see Bloomberg up 114%, Fox Business 80%, and CNBC 65%. So definitely big gains in the news networks. And John, since we've got you on, we thought we'd take a look at the halftime report as well here.
There you go.
And see what the halftime report is looking like here. So what we charted here is in red is the stock market since the beginning of the year. And in the green line is the viewership of your program since the beginning of the year. And interestingly enough, there's a direct inverse correlation here between viewership of the halftime report and the stock market. So there you go. There's some bright spots in here for everybody.
Well, thank you for sharing that one in particular.
It's a great picture here. I love it.
Yeah. And as you and I have said, if it bleeds, it leads, and people definitely tune in more to financial television, thankfully ours included, when the markets are down, because as they always say, don't confuse brains with a bull market. When things aren't just going swimmingly, that's when people tend to want to listen a little more.
Yeah, the numbers show that here. The next thing we did is we took a look at the media holding companies and we said, all right, we know that their ad revenue is down, right? A lot of this is driven by sports, but what we wanted to see is how does the drop in ad revenue compare to the drop in stock price for each of these media holding companies? So let's start with NBC, Comcast, and Viacom, CBS at the top. And interestingly enough, you can see NBCU has had a drop of about 18% in their ad sales since the pandemic hit. Again, all mostly driven by sports. And that happens to be almost exactly the drop of their stock price from the peak of February 14th or so. Same with Viacom and CBS, almost exactly similar, 53% drop in ad sales, 54% drop in stock price. Then you get into Disney and AT&T, Warner Media, who are companies that have a lot sort of diversified, have a lot more going on. So here you're seeing a 17% drop in ad sales for Disney and a 25% drop in stock price. Of course, for Disney, you've got their parks that are closed, and you've got a lot of other things going on there as well. AT&T, Warner Media, ad sales down quite a bit. The stock's not down as much because obviously they've got the wireless business and other businesses that are more diversified. But we thought it was interesting to look at the difference in the drop in ad sales and the stock price of these companies. But speaking of media companies, while the traditional media companies are down, the streaming services really are capitalizing on what's going on right now. And with that, actually, we have our second poll question, which you guys see in front of you. We'd love to hear what streaming services you are using the most right now, because all streaming services are seeing an uptick. And in fact, looking specifically at ad-supported streaming services, their ad revenues are up 41% year over year and 10.6% post the pandemic compared to right before it. What we're also seeing are these streaming services are spending a lot more on marketing their own services. So we've seen streaming services spend $125 million on TV advertising just since March 12th of this year. And Hulu is the one that's increased their spending on their own marketing the most, and they're up 632% year over year. So that's what the ad market looks like from a media perspective, from a media company perspective. Then we want to take a look at how some of the industries are faring. So what we did here is we pulled up the top 9 industries that are spending the most on television advertising, with insurance being the number 1. And this is from March 12th through yesterday. So insurance has spent more than any other category from March 12th through yesterday. And they're still down almost 18% year over year. So the insurance category has pulled back. Automakers have really pulled back. Over 50% of their ad spend has been pulled back. And you can see pretty much there's drop in ad spending across the board, with some exceptions like skin and foot care is up, for example. So go get those lotions. And video streaming services are up as well, as we discussed. But what we want to do is dive into a few industries here and take a look at what those look like. And I know we have about 8 minutes left, so we'll try to kind of rapidly move through some of these industries. So we've talked about auto. I think everyone knows the auto industry has got some real challenges on their hand. They've pulled back their TV advertising. Their many dealerships are closed. Web traffic is down 25%. We know this because we measure a lot. We do a lot of measurement for automakers, and we also measure how TV impacts their web traffic and their sales. And you can see brand by brand the drop here. But what we've observed is the brand that's pulled back the most on their TV advertising is General Motors. And General Motors is basically all but completely pulled off air for GMC, Buick, and Cadillac, and they're only running Chevy right now. General Motors is also very sports heavy advertiser, so that's another reason that's driving this. But out of all autos, General Motors has pulled back the most from TV advertising. We're also noticing some interesting trends in auto in terms of messaging. All the automakers are deferring payments, or offering as good as financing terms as really they have in a long time. They're encouraging people to shop online. They're pushing their servicing and cleaning. They'll come to you. And of course, we're seeing a lot of patriotism and empathy in their ads, as we're seeing across a lot of other categories. And another category is travel, and this is maybe the grimmest one of them all, on multiple levels, including TV ads. I mean, these guys have pulled back 86% of their television advertising. You see cruise lines are all but non-existent on television. Booking sites, hotels are way down. And you know it's telling when a travel company changes its tagline to "just stay home." That pretty much sums up with the state of affairs in the travel sector. On the flip side, food delivery is capitalizing on this, and we took a look at pizza in particular. And Domino's stand out as really a strong performer here in this category. Domino's is a company that's done really well over the last several years. They've really invested in digital and in their infrastructure. Their ad spending is actually up 23% year over year post-pandemic. Their web traffic is up quite a bit, 10%. But this is web traffic in the pizza category, so not specifically to Domino's, is up 10% from the period post March 12th. And we thought we'd take a look at kind of Domino's from a historical perspective. I think this is an interesting trend here. In green, you're seeing Domino's stock price since the beginning of 2015 through now. And in white, you're seeing their TV spending over the same period of time. So you can see a very interesting correlation here between the amount they invest in television advertising and the growth in their business. And in fact, you're seeing periods of spikes here in their TV advertising that precede areas of growth for them. So some really, really interesting trends to look at here. And speaking of food delivery services, we're seeing this category really, really explode. And companies like DoorDash, who just announced their intent to go public recently, of course, we'll see what that looks like, have really cranked up their spending. And not only are they being very opportunistic on their own business, they're really capitalizing on helping restaurants. And in fact, their top line messaging is, while the doors may be closed, the kitchens are open for delivery. So food delivery is definitely a sector that is very opportunistic here. So that's our quick kind of overview of how the pandemic is impacting the television ad market using some of our real-time data.
Yeah, and obviously, you know, somebody like when you talk about, Sean, how much the autos have cut back on advertising, I think all of us recognize that because we're so used to just being peppered with, whether it's Cadillac into, you know, more high-end events like Super Bowl or whatever it might be, Masters, March Madness, whatever, where they think they have, you know, a larger audience with more affluent within it versus, you know, the Chevy ads that you're talking about right now. Ones that I've seen like crazy are those car delivery, Carvana, and it is up like crazy. You can't watch a show and not see a Carvana ad. So that's pretty interesting, especially because I asked you at the top, you know, which financial folks, how are they using this data? I guarantee they're using your data for Grubhub and how that's doing. I guarantee they're using it looking at Carvana, you know, any of these publicly traded companies. And then you nailed, you know, as far as revenue, ad revenue and things, Comcast, how they're doing, you know, you contrasted that over with CBS and so forth, that lost March Madness and how much revenue's down there. But auto delivery, who would have picked that one, right?
Yeah, John, that's a great point. I actually think what's going on in auto is going to help companies like Carvana quite a bit, because all the autos are now pushing online purchasing of vehicles. And obviously the Carvanas of the world were built from the ground up to sell cars online. So they're actually much better at it than the traditional OEMs. And you are right, Carvana is being very opportunistic. They have increased their spending, and I think this is going to help companies like that. And I think that's a great observation.
And Sean, I guess if we could just move to one question, you know, how does your data deal with, you know, time shifting or DVRs? Are you still able to capture that, or is that something of an issue?
Yeah, that's a great question. Yes. So not only are we able to capture time shifting and DVR for the programs, more importantly, we're able to capture time shifting for the ads, because what's going on today in time shifted environments, quite often ads are being skipped. So from an advertiser perspective, it's great to know how much viewership there is for a program in a time shifted way. But it's really important to understand the ad consumption. And not only that, typically ad loads are different in time shifted environments. So if you watch a program on demand 7 days after its original airing, you're going to have a completely different ad load. And that's why it's so important to decouple the measurement of ads from programs, which is exactly what we've done. Great.
Well, it sounds like it's going to shape up to be an interesting 3Q, 4Q, you know, where will the dollars go? What will happen with the NFL? Will that be a big draw to get the auto companies back into spending? You know, how the networks are gonna be seeing viewership trends. So once again, this was the end. We're coming right up to the 10 o'clock hour. But if you're interested in meeting with iSpot this afternoon, you can email us at info@battlefin.com. Once again, thank you, John. Thank you, Sean.
Hey, Tim, one last thing. Can we see the results of the polls?
Yep, I was going to get to those while Todd pulls in the next presenters as well. I'll talk about the first one, which is the NCAA was the winner. That's what most people are missing, March Madness. About 20% of the audience didn't care. So we've got a tech data savvy crowd, which crunching numbers. And then we didn't, there was a boycott. We lost a couple of viewers because football/soccer wasn't on the list. So hopefully for the next poll, we can kind of do that. And then Todd, do you have, I don't see the second poll results, but it looks like that was the, we'll pull those up. I think they were still being tallied if we have to end the poll and then go to it. But
There it is.
we'll mention it as we start the next one. But thank you, Sean. Thank you, John. Appreciate it.
It's up there. Netflix, huge winner, 60%.
Interesting. Okay. Great. Well, we'll add Mark Lopresti and Kevin Tingley to the panel, and we'll get started with the next panel and keep things rolling. So
Thank you, Sean. Great job, sir.
John.
The next one is No Pressure, No Diamonds, Finding Investment Ideas in the COVID-19 World Using Alternative Data. Let's see, stop share results on the polls. We'll have you give Mark the audience. Is he live? Mark, are you there?
I'm here, Tim. Can you hear my audio?
Yes.
Yep.
I don't have a visual.
Okay. Well, we can, let me just share my
There we
screen,
go.
kind of show people something here. Mark, oh, there you go. We
Yeah.
can see handsome face now. So
There we go.
why don't we turn it over to you?
Hey, fantastic. Thank you so much, Tim. And thank you to all of our BattleFin first virtual Discovery Day audience attendees. We really appreciate you all joining us this morning. And before we start, I want to give a very big thanks, as always, to the BattleFin team, to Tim and Todd and Rob and Chris and Ish and all of the people that make these conferences happen, both in real life as well as virtually. Obviously, crazy times that we live in here, and really proud to be part of BattleFin and the alternative data community as we use alternative data to help people navigate these unbelievably unprecedented markets, to help understand the ongoing path of this horrible pandemic that we're dealing with, and to generally make us better informed investors and better informed business people. Today, very interesting day, market sort of flat as I last looked. Disappointing numbers both on employment, disappointing numbers on housing starts, much worse than the street expected in both categories. And I'm pleased to have here with me today for the No Pressure, No Diamonds panel. A really great topic, and Tim, whoever came up with that one, I like this panel title. Two executives with alternative data providers that we've come to know very well, that have uniquely actionable, consumable insights that are being driven by their data and analytics. I'm happy to be joined by Kevin from CamGen and also Patrick from 2IQ. And I'm going to open this up by allowing each of them to give sort of a quick overview, their background, their firm, the kind of data that they produce. And then we'll get into some questions in a sort of a fireside chat style format, where I'll ask these two executives a bit about their data, what makes it special, unique, and actionable. And then we'll open it to the audience for some questions via the chat app. So Kevin, I think we agreed we were going to start with you. Hopefully you're ready. Todd, if you want to do the screen share for Kevin, that would be great.
That'd be great. Mark, I appreciate you guys having us on today. And it's good to see you once again. Just going to miss the cocktail hour after the conference today and sharing a cocktail with you as usual. But, the opportunity to get in front of you guys and share a little bit about what we're doing is always a great opportunity for Camgen. So just real quickly for the audience that might not be familiar with us, Camgen was started back in 2006. Primary focus of Camgen is in U.S. government RDT&E research and technology services, meaning we build technologies for U.S. government and different departments and groups within the government, from the Department of Defense, the Department of Energy, Homeland Security, Army, Joint Special Operations Command Group, you name it, we've worked with them on the government side. That continues to be a large majority of our business. We did get into the alternative data space about 2 years ago, where we built a derivative product off of the technologies that we've developed called Egbert. It's a sensor processing platform that collects signals in the field, processes them on a edge computing architecture. We deliver that data back over the cloud via 4G LTE cellular connectivity. And that data is processed in an environment where we then deliver it to our clients. And specifically, the data that we're focused on is within the industrial manufacturing vertical, specifically around heavy equipment. But we also do custom projects and have done other things outside of just heavy equipment. But the main bulk of our focus within our alternative data market is really looking at those companies producing the heavy equipment. So they're very large macro players with global footprints. So you think of companies like John Deere, Caterpillar, AGCO, PACCAR, Navistar, Spirit Aerosystems. Those are the types of companies that we're collecting data on, which obviously, given the current environment that we're in now, people have a real thirst to get an understanding of what's going on there in the real world. And going forward, as we're now in an environment where the market has, or these companies have suspended guidance, you probably won't see much guidance from them at all this year. What we do in the data that we collect in the real-time nature and from a ground truthing standpoint is really insightful information and can give clients a look to see what is actually happening when they aren't getting little to no guidance from company management during their earnings calls.
Okay. Fantastic. Very useless, very useful, information. You've been very gracious to share it with us. I know you guys updated your report just yesterday, hot off the presses. I took the liberty of sharing it with John, who I know mentioned it yesterday on one of his live streams, and possibly even on Halftime Report. And thanks, John, if you're still watching, for covering the last panel with us. But clearly, without a doubt, Kevin, actionable, useful, relevant real-time data that people can actually use to identify trends in some of the most important names, as you've mentioned, Caterpillar, John Deere, and we're gonna come back to that. But turning it over now, so Kevin, thank you very much. Turning it over now to Patrick from 2IQ. Patrick, you guys, as I understand it, look at buying and selling action from corporate insiders, but you guys do it in a really, really unique way, and you have access to some information, or you analyze that information in ways that folks haven't done before. Obviously, watching what corporate insiders do in terms of their personal holdings has been around for a while. So we're very anxious to hear how you and 2IQ bring a new, unique, and highly differentiated spin on insider buying and selling. So let me turn it over to you, Patrick.
Yeah, thanks, Mark. Just a quick introduction. So I'm co-founder and managing partner of 2IQ. Thanks for having me. And I want to give a little bit of introduction to the company and the data set and how we see our data. So 2IQ was actually founded in 2003. We were kind of a university spin-off. And we are consider ourselves as the experts in insider transaction data and analytics. We truly have a truly global data set. We're focused on technology, on data quality, on speed. And in 2006, we started the collection, and over time in 2008 and 2012, we started the European and global feed. And now actually our clients are asset managers, investment banks, hedge funds, prop traders, also data vendors like Bloomberg. They're displaying our data for 40 countries. FactSet, the Open FactSet marketplace is displaying. Wharton research data, we give our data to academics. So there's a broad range of clients that actually have access to our data. And just to be clear, what is insider transaction data so that everyone is on the same page? So we are monitoring the management and the supervisory board globally. In some countries, even further than that, some companies or legal entities are defined as insiders or middle management. So we follow in total 500,000 people. So if you were just to look at US data, that is probably 1/3 of our data. The rest is actually global. And what we actually do like about the data is that our insiders, they put their money where their mouth is. They're not saying the company share price is too cheap. They're actually investing. And in the case of the crisis, we have seen millions of dollars spent or bought in company shares. And we actually provide signals based on the data. So we have several products. One is the model score for each company, but we also have fundamental investors products, and typically our signals provide orthogonal value or is very uncorrelated to existing factors. And yeah, we have two major use cases. So on the one hand, we are providing signals for stocks. So on any given day, we process thousands of companies and have a kind of opinion on them. But also you can use our data in terms of market, sector, or country timing. And I have prepared some examples. So for example, now this is the first use case. If at the beginning of the crisis, or in this case, end of February, you were to buy the top 20% of our scores, so roughly, I don't know, 500 stocks, and went short 500 stocks, this was the performance that you could achieve during the sell-off when other quant factors melted down. So at the end, we ended up with 4 to 6%, depending on the region. And our model is purely based on the behavior of executives buying and selling their shares. And their behavior is ultimately driven by valuation. So if they think the sell-off in their stock was too extreme and the long-term prospects are better than the share price, they will buy. They are anyway overexposed usually to their share price. If they buy shares, that means something. And also, like in an historical context, I wanted to highlight that the March 2020, we had 4% outperformance from the long portfolio versus the short portfolio. And that's a historic record for our model. So it was specific, and now I'm talking about the out of sample production, which is since 2016. So our clients were able to act on either on single names. They might get a list of a lot of companies. For example, I have a list of long ideas here. So we have seen buying from CEOs, CFOs, through a lot of names. And yeah, this is kind of a list of the companies that we rate high currently. And I have drilled down to companies with CEO, CFO buying, chairman of the board buying. So actually in all industries, we have seen buying activities. And vice versa, we have also short ideas where we see high level selling from CEOs, CFOs in tech companies, in Zoom. So there's a lot of names that our clients will receive from us. Yeah, and our model is built from our head of quant research 4 years ago, and we're kind of very proud of the performance. And yeah, we have clients that are using the model scores. So that would be the one use case that I wanted to highlight. And the second use case, just very briefly.
Patrick?
Yes, sure.
If you go back one slide to page 8, and I think maybe that was a 2-page, was there one behind? There we go, yeah. What is the time frame that's applicable to what we're seeing on the long side use cases?
Yeah, I mean, I would say the typical use cases will have kind of a 1 month look back window, but we have clients that look just basically at the activity of the last week. I think this list or the score is compiled for roughly a month. So the Exxon Mobil buying activity could have occurred already 2-3 weeks ago. So this is not like a super current list, but we're flexible. So our clients could use the recent activity for a short-term model or for short-term trading, and a long-term activity up to 3 months for positioning them for 3 to 12 months, for example.
Okay, thank you very much.
Yeah, and just briefly, because this is the other very interesting use case, market timing. So in this chart, you can see the S&P 500, and the blue bars is the buy-sell ratio. So what we are comparing is the buying activity and the selling activity on any given month. And you can see that in those crises, from financial crisis or the EU debt crisis or the slowdown in emerging markets, the trade war, and now the COVID crisis, in these sell-offs, insiders really take money in their hand and buy their own company shares if their share price is undervalued. Usually this buy-sell ratio is well below 1. And we have observed now buy-sell ratios in March of over 5. And this is really exceptional high. And actually we put out a press release because we thought like this is exceptionally high. We almost hit the bottom, or timed the bottom of the market. But yeah, the market was still very volatile. 2-3 days later, we hit the bottom. Yeah, and we can slice and dice. For example, this is how it looks when you go by country. So you can see now here, since January 2019, the buy-sell ratio through all the countries. I apologize if you can't fully read that. But for example, basically in most countries where it was neutral or even bearish before, all countries simultaneously turned to green and basically posted record buy-sell ratios, most bullish sentiments in all countries. So that's what we see in our data.
And that's for March of this year. Am I understanding that correctly?
Yeah, so the highlighted column is March, and the color coding is, if it's very green, it's basically kind of a record high. So we have seen in many markets record highs. Most of the markets that you see is Europe, but also US is here with 4.5, really, really high buy-sell ratios of the top insiders, the group that we like to look at the most. Yeah.
Patrick, are you also looking during the same period at who's not buying? Right. So what of your corporate insiders that you're tracking have decided that, notwithstanding their own stock price being at an unprecedented or historic low, they've chosen to take a pass because that might be as big an indication of anything as their decision to increase their positions?
Yeah, that's a very interesting one. So on one hand, they also have blackout periods. For example, typically now the first 2 weeks of April, they're kind of restricted before the earnings to buy, right? And only we will see more activity once they publish earnings. So when the playing field is leveled, and then we can actually differentiate which companies put money in their own shares or which executives. So I don't have a list of that, but of course the lack of insider buying is also a signal, but it could now be because there's a blackout period and then not allowed to sell. So you have to be a little bit careful on this analysis.
Terrific. And Todd, normally I'd look to the back of the room to see you waving at me, but I think we've got two or three minutes. Just give me a thumbs up if I'm right on that. 2, okay, which means I'll take 3, as you know. Kevin, I want to turn it back over to you and to CamGen. So many people in our audience and the broader financial world really curious about what your numbers are showing in terms of strength or weakness in industrial manufacturing and agriculture, and possibly even how those two industries may be perhaps inversely correlated as we go through this period of maybe reaching an apex here in New York with the pandemic and looking to coming out the other side. What say you on that?
Can you guys see the screen?
Yes.
Yep. Okay. So, we started seeing a significant change in early March in our data. traditionally the spring to summer season is when most of these heavy manufacturers are building inventory to meet the summer and spring construction and agricultural spending season. So if I could just share with you what we put together, this is just a sample of our deck, but we wanted to get data to our partners, to our clients and prospective clients, given the uncertainty in the marketplace. So we quickly formulated a report to show activity across all of our companies that we're monitoring and their data sets. And the main thesis was that you would expect to see production and activity increasing throughout February, throughout March, throughout April. Now, if you notice in this chart, you certainly see that in the first 3 weeks of February, but immediately you start to see a noticeable decline in total activity across the board. And you can see that extrapolate, down into the 20th here. This is about the same time, the week of the 23rd, when companies came out and started, talking about shutting factories. Ironically, it's the same time that John Nigerian and Mark reached out to us to share some information that we had as to what we were seeing in John Deere and Caterpillar specifically. So the main thesis at that point in time was you really have a situation where you have companies that are involved in heavy construction projects versus agricultural products. And on a relative basis, we say that we activity in the agricultural space remain steady to actually improve versus companies in the construction space. And that being very logical, that the spring planting and harvesting seasons around the world obviously cannot be ignored, right? Whereas, construction projects, whether they're private or public projects, are going to be certainly halted, if not delayed indefinitely. And that report is being sent out weekly now to our client base. In addition, we've had a partnership exchange of information with Jefferies over the last 3 to 6 months. They are familiar with us, our data, and their industrial actually started monitoring that activity, and they are reporting that with a published report on a weekly basis as well too, which we're starting to see some very keen interest in, people asking a lot of questions, as well as companies asking questions. Because again, in an environment where there's a lack of information, there's a lack of guidance, what we do in targeting high value targets at the ground truth level can actually give you insight into what's happening at those companies, those factories in a real-time basis. So you can actually get insight into, hey, what is the quarter going to look like potentially based on the activity that we're seeing? So getting a lot of good feedback from our prospective clients and our current clients.
Well, Patrick, that is absolutely terrific. We're going to have to wrap it up here as we move on and prep for the next panel. We will continue to very actively and closely monitor the information coming out of both 2IQ and of course from CamGen. Continue to look for updates on BattleFin, battlefin.com. I'm sure John will continue to feature some of this on CNBC. And just a big thank you to everybody that tuned in to watch our first virtual Discovery Day. We're incredibly grateful for your time and attention. We'll be back live as soon as it's safe. And I'll wrap this the way I've wrapped all of my webinars and live streams since the pandemic began. Entrepreneurs and small business and the investment community will lead this recovery. The BattleFin data community will be a big part of that. I can't wait to see all of you live again very soon. Stay healthy and God bless. Tim, back to you.
Great. Thanks, Mark. Thanks, Kevin. Thanks, Patrick. And for anyone that is in the audience that is interested in meeting with either of those companies this afternoon, please let us know. Both 2IQ and CamGen are on Ensemble. And I think, if you see my screen, one of the cool things is both of them have their data available now. So that isn't something where you're going to click and, 3 to 6 months from now get access to the data. It's something you can be watching in terms of real-term recovery, what's going on in industrial equipment, how are things changing on a daily or weekly basis. I think the 2IQ data is actually intraday, so you can be seeing who's buying which insiders are doing that in which industries. Pharmaceuticals had a great March, and that was led by some of those different data points. I'll pass this over to Rain, who will be the moderator for the next panel. Welcome, Rain. Thank you for joining, and I'll hand the controls to you. Don't go anywhere. Can you hear us, Rain?
I can hear you. Yes. Can you hear me?
Yep, we're all good. Take it away.
Okay. So I'd like to thank everybody for joining in. I know this is an awkward situation, but let's make the best of it. Thank you initially for, of course, to the BattleFin team to put this together. I'll introduce our panelists. So actually, before that, I'll give you a little bit about who I am. I'm the head of data strategy for Jefferies Equity Research. My function is to sit in the middle of our fundamental research department and help fundamental analysts understand what data can do. We work a lot with people like with BattleFin and with a lot of the vendors around. Many of the vendors here either already work with me or we've met in the past. And we try to help fundamental analysts, like I mentioned, actually utilize this data to answer key questions. So not a quantitative question, but truly a fundamental question. For another small piece of my background, I came from the buy side, spent many years as risk management in that space, but have now transitioned to the sell side to help many other investors work with this. I'd like to introduce our two panelists. I'll give their names, but I'll let them give a moment to actually give their backgrounds. We have Micah Sachs. He's the Director of Client Analytics and Insights at Comlink Data. And then also Clinton Libby, the co-founder and managing director at Kumi Analytics. Please, why don't we start with Micah? Can you go through your background and give us some of your background, your firm, and all those kind of things so we can run through that?
Yes, of course. Thanks so much, Rain. Yeah, so my company is Comlink Data, and we provide highly granular telecom market intelligence. Our primary customer base actually is carriers, including many of the top wireless and broadband carriers in the country, as well as many of the top device manufacturers from around the world. So, but then we also serve investors as well. And so my background is I have about 10 years prior to this working in telecom strategy consulting, working with a wide range of clients, investors, carriers, regulators, et cetera.
Excellent. Okay, let's do the same thing. Clinton, can you give us some of your background and walk us through how we should be thinking about your product?
Sure. So hello, everyone. Clinton Libby, Kumi Analytics. And we are focused on leveraging satellite imagery and geographic data sets in order to help provide insights into economic phenomenon. And a little bit about myself. I've been in the mapping industry for about 30 years. Most recently spent the last 8 years at Google. And the genesis of the company was we started to see significant amounts of satellites getting launched, the movement towards cloud processing and the ability to actually process this data and extract insights with artificial intelligence and machine learning methods. So that's the orientation of the company. And it really goes back to, for me, at the beginning of my career, the inventor of digital image processing shared with me that we have to turn this imagery into text because 99% of the world has no idea what satellite imagery is, but if we can provide actionable insights from it, that will help them do their businesses better. And so I'm sensitive to that issue because I know that in this call, quite a few people probably are not familiar with satellite imagery. So our goal is to make it easy to consume and to help you gain insights into the economy.
Great. And then as a background, I just want to let everyone on the audience know we are using the question and answer function. Please, I like to make sure that during these kind of dialogues, it's not just my questions. If you do have a question, this is the moment, let us know. We'll be sure to incorporate those within the conversation. Okay, well, so we had on our preparation for this, we went through a couple areas we wanted to cover. And so I'll just give the audience some background to that. We, of course, can look at the current environment. It's always a good idea, especially from my seat, and I assume from a lot of your seats, to understand what is it you're actually going to get from these guys. So we're going to talk through some of that. What is the actual data? How would we receive it? All that. And then we also want to talk through some aspects around what's the normal world version of this use case, right? So we'll go through some examples of how we can think about using this type of data from both sources in a not COVID environment. But let's start with COVID because that's what everyone's talking about anyway. I'd like to start with the Kumi product. I'd like to get into how would we think about using your data in the current state of the world. So can you talk some about your with the sourcing of your data and the migration, or the thinking about it as a data as opposed to images? When did you start to recognize a shift in production and how things were varying from, quote, the norm in your data?
Well, in China specifically, we started to see that with the January data, where it started to, but it was tricky this year because it was Chinese New Year. But there was a strong confirmation in February of the level, and that there was not a recovery from the typical drop in radiation and pollution levels of a Chinese New Year. So it was, I would say, the data it's shown in January, but we had the confirmation in February of the extent, and that it was something to be addressed or looked at.
Got it. Okay, and so we're saying you see that kind of starting to drop down, and then when, I mean, it's a loaded question, but I'll ask it anyway. When would you start to expect to see the utilization rate to shift? Is there any inflection you're already observing, or maybe even by sub-regions or aspects like that?
Yeah, so that's one of the things particularly with the virus. You have specific areas within China actually that were growing, while the areas in Wuhan and Beijing and Shanghai were dropping, and then we started to see recoveries earlier in Wuhan, and then Beijing getting worse. And we're starting to see that in the news now, where they're starting to shut movie theaters in Beijing and Shanghai just as of the last couple of weeks, whereas Wuhan is opening back up. So there's a shift. Oh, there we go. I'm going to show something similar to that later. So there's a shift as it moves around the country, and you can see different areas that are actually performing quite well. And we're also with the pollution data, we saw an initial jump up after Chinese New Year, and then it quickly fell back down, and it's a slow recovery, which I'll show in more detail later as well.
Got it. Okay, so let's shift gears. So on the Comlink data, can you, I mean, we gave a little bit of the intro at the beginning of it, but this is often considered data that you would look at for a very defensive space. Are you seeing things in it now, and are you seeing any kind of shift or way of understanding how things are improving?
Yeah, just a second. Let me share my screen. Okay, are you guys seeing my screen?
Yes.
Okay, so yeah, just a quick overview on Comlink data. As we discussed, we're a market leader in providing highly granular telecom market intelligence. And so as far as the sourcing, it's based on a 200 million plus smartphone panel with 2,500 applications active at any given time. And so what we do is we take the raw signal and we transform it into KPIs, because as I said, the original use case was for carriers. I can get into a little bit later all the pieces that people get, but in terms of what we're seeing from COVID, so you know, one of the key things that we're tracking is where subscribers are going between different broadband providers, both in terms of the type of provider as well as the type of technology that they're going to. And so in this, you know, we saw mid-March with most states shutting down, so many people going to work from home, school starting from home. What we saw was an interesting shift from in areas which are served by lower speed technologies such as DSL, switching to cable. And so if we look on a year-over-year basis, what we're showing here is all DSL areas of the country. So this is areas that the telco in that area offers only DSL technology, and that's something like 50-some million households. And then they compete against cable providers. And what you can see here is if you look at the 2017 to 2019 trends, you see a certain kind of standard trend, but in 2020 you see a real drop. Right around the time of the widespread work from home and school closures beginning. And conversely, you see a less pronounced, but still material increase in the share taken by cable providers.
Interesting. Okay, so that's potentially impactful, and it's also an interesting piece that like I kind of led with, you wouldn't think to you look at this type of data necessarily until you start to think through the second tier ramifications of how people are using this, where it's going to pump in. So that's potentially powerful. Can you speak to, so we spoke some on the preparation around some other data that you are incorporating, you're starting to bring in. And while it's not something you necessarily have fully vetted at this time or fully available as a product, there was some conversation about things that you feel that you'll be able to incorporate in the future. Can you give us some context around these other types of information that we could expect to be able to work with you on?
Yeah, sure. So in the short term, we're going to be launching. So the product I showed you is from our broadband carrier vision product. So that's specifically focused on residential broadband. In the coming months, we're going to be launching a wireless product, which tracks, effectively tracks flow share subscriber movements within the wireless market. And then our company also recently, over the past year and change, bought a company called Tutela, which is a leader in providing network performance data for both mobile and fixed networks. And that is something we are working on, developing a product for investors as well.
Interesting. Okay, so that's something that while not necessarily fully there, could be something we could talk with you about through the one-on-one, something like that, and to help understand what's coming available, so we better know what could be done with your overall product. Excellent. Cool. Well, so I'd like to shift the conversation a little, and just because I care a lot about plumbing, and I think that making sure that we understand what that is matters, because the reality is you can describe these things, and both Mike and Clinton, you can tell us all about the cool things you can do, but until we understand how we'll use it, it's always that challenge. So let's go back to Clinton. Can you walk us through, what do we actually get? Like you've mentioned pollution and radiation and these kind of things, but like those are measures being derived from your primary data source. Like, can you walk through, like, if I subscribe with you, what am I receiving? What's the regularity? What is the actual output going to be, so that I can then think through how I would apply that?
Sure. So basically what we would provide is CSV files. So we'll provide basically spreadsheets of data with different administrative boundaries and geographic regions, whether it's countries or states or provinces, and or counties, and being able to see the level of activity, economic activity in those specific regions. One of the things I like to say is, where there's light, there's a transaction happening. And business happens with the lights on for the most part. And so when we see different levels of light or other things such as pollution, we can break that down to the geographic area where it's actually happening.
Well, can you give me some understanding? So I often thought about satellite imagery and thought, oh, well, there's gaps in coverage, frequency of update, all that. And I'm not trying to trick you around it, but just understand, like, if I'm receiving a data set from you that is some regular update to it, are you capturing, like, let's use China for the example. How often do I actually know the change in light radiation for point A in China?
It'd be monthly.
Monthly.
It's a daily data set. And actually, I'm just going to quickly share my screen. I have a slide on this. So basically, can you see that all right? So when you think about satellite imagery, there's really a variety of types of data sets, and the optical imagery is where you're going to be. You can see ground-based observations, and there's a lot of other data products out there that account objects on the ground and will tell you how many ships are in a port or how many cars are in a parking lot. And one of the things about that data, it's valuable, but it's limited by the orbit. So the point you're talking about of getting data every 16 days or every and then you have the issue of clouds, and there's issues with satellite orbits, and then you're competing with the government very often to try and get data of the area of interest. And then another data type is synthetic aperture radar, which is really good for ground-based observation of elevations. And then there's the infrared data sets, that's where you have weather forecasting, pollution monitoring, identifying heat signature activities, radiation of light, particulate matter, vegetation. And that data set typically have daily daily radiance values. So what we do is we get the daily radiance values every day, and we then correct for all of the issues, whether it's clouds, the effects of moonlight, snow, sun, ice, all these things, and then basically from there we will then process that into numbers for specific areas, and then we could look at a country. So this is an example of looking at China and identifying all of China with our light radiance, and this is the Hang Seng Index compared to our radiance values here with a 120-day lead.
If I could repeat it back and see if I understand. So you're receiving for any given point on that monthly kind of update, but at the same time, because you're receiving numerous different points, you're combining them together and creating an aggregate that is not every single point being updated every day, because that's not possible, but you are getting some level of update on a regular basis and inferring the variation. Is that reasonable?
Exactly. And then we can identify momentum. Is there an increase in economic activity over the course of that month compared to the prior month?
To confirm something, so you'd mentioned the level of granularity. You were mentioning, regional and city and geographic definitions. But one of the questions from the audience was, are you able to give the specificity around GPS coordinates or latitude, longitude, something like that? So if I know where a mine is, I know something like that, can I get information for that point?
Absolutely, yeah. Okay. Anything within about 500 meters to a kilometer in size, we can monitor those on a regular basis.
Well, so I'm gonna pivot the conversation again because I want to make sure we're able to use the time appropriately. So Micah, can you help me understand within your data, right? What is it, similar kind of comment, how are we thinking about this? How are we actually utilizing it?
Yeah, sure. So I'd say, there are kind of two main use cases that people use our data. So the one way to first that you got to remember is that it's a directly investable KPI. The data that we produce is actual net additions of subscribers. So this is a key KPI used. So there are kind of two ways that people use it. One is in quarter. For in-quarter trading, we produce forecasts on a monthly basis of net additions for all the major broadband providers. And these have a very, very strong level of historical accuracy. And so there's that in
the trust but verify, but so
yes, of course.
Understand the actual result or the actual thing we receive from you, right, is this daily concept, right, of net adds or net changes per carrier, because you have all the carrier underlying information. Is that right, or am I missing a piece?
Yeah, that's basically correct. I mean, there's a platform where you can access whenever you want daily updates to data on the different broadband providers, and you can cut it in all kinds of geographic ways, all kinds of competitive overlap ways by technology. Just about any measure that you would want to cut it by.
The panel is roughly 200 million phones, right?
Yes.
So as a result, like if we think that the US, I read some statistics the other day, it was like 270 million phones, something like that, smartphones in the US. So you've got 2/3 of the phones in the United States telling you about their sourcing of information on a daily basis, giving me broadband use or broadband telco operator churn.
That's correct. Yes.
So that's not small, and that's if you want to know the answer to that question, that's probably the answer to that question. So that's pretty great. So when we're thinking about that, that kind of opens up the what do we do in a normal situation? Well, if normally I want to know the difference between these telcos, and if the key question is who's taking share from who, either geographically or over time or whatever, I call you and you have a data set that should be able to give me that answer.
Yeah, that's right. I mean, I think a way that a lot of the more the investors that have more long holdings are looking at it is they want to dig down below what's reported in terms of competitive performance. So say specifically, if you're invested in Altice and you want to understand how is Altice performing against Verizon areas where they offer fiber. That's not something you can get from reported, but you can get highly granular information on that from our platform.
You would know from your data physical overlap and relationship as well as time-based overlap, correct?
That's correct.
Cool. Yeah, so the scenarios you're just describing. So say I want to think about a private company that's moving into a region, I could actually use this as part of that conversation as well.
Yeah, we cover a universe of 600 plus internet service providers.
Interesting. Okay. Okay. Well, so I had some other questions I want to. We have just a couple of minutes. I will again ask the audience if there are other questions. Please, we'll happily pull them up from here. But in the meantime, I'm going to ask a couple more.
We're gonna have to move to the next panel. But I wanted to let you conclude, and then I'll have a suggestion for some people for the CUMI analytics data, and also for Micah, and bringing some of the questions. We'll follow up with him after the call. I'll let you close out.
Fair enough. Okay, so I won't ask any more questions. Sorry, we'll save that for another time. But again, Micah and Clinton, thank you very much for your time. It was a pleasure to get to know you for this. I know I have some follow-up questions for you, as we, in my role, are trying to answer some of these questions, and there's aspects around this that I think could be pretty exciting. So we'll be in touch. And then as far as the audience and the panel, thank you for participating. You know, this is an interesting time. Hope everybody's safe and sound. And we will be talking again soon. Tim, I'll leave it over to you.
Thank you, guys.
Thank you.
Thank you. Just in terms of the CUMI analytics data is on Ensemble, and for those of you participating in the one-on-ones this afternoon, you know, you can actually scale down and access the data through Ensemble. I know that in the case of Clinton, they've built some exploration kits, so you can actually go in and when you're doing your one-on-ones, open up the exploration kits, provision the data, and actually have them walk you through some of the use cases and examples they've built. So that's kind of an interesting way to really dig into the data. And like we have been emphasizing, it's in this time, you need data now. You don't need it 3 to 6 months from now. You need to be tracking the recovery. I see that Rob has joined, so I will hand the call over to you, Rob. Welcome. I think you're on mute, but there you go. I'll let you guys start the next panel.
Hey, Tim, great. Thanks a lot. Hope everybody is enjoying their staycation as most as they can say. We have a panel here that we're going to actually talk about what everybody is thinking in their minds, which is what does the consumer look like after COVID-19? There were some great sessions this morning talking about some of the data. I'm going to introduce my panelists in a minute. Is I have Gavin Mormon from Foursquare, and I have Jeff Schmidt from JSA Advisors. What I like to do first, though, is set the stage. I have a bit of a historical bent. So like most of you who's been trapped in their basements or apartments, I did some reading and I tried to go back and look at, like everybody else, everything I could. And I went back historically to the, I would say is the first Great Plague. There was another one before that, but what we all know is the Black Death, which they called the Great Mortality back then. Two stories I think that are allegoric that I want to highlight for you is that these are big changes, and potentially COVID-19 and the consumer has some big changes in structurally how we see. The Black Death itself just changed the face of employment and also the relationship between those in power and those who didn't have power. 50 to 60% mortality rates meant that there was a labor shortage and pretty much put the power back into people, but that changed the relationship between those in charge and those who weren't. Also is, for those you don't know, 1350s is the Black Death, 4850. That's the beginning of the Renaissance. And I want to draw your attention to one little story from Giovanni Boccaccio, who wrote the Decameron, which if you read is about Florentines who escaped the city to go to the countryside to hide out from the plague. And what Boccaccio describes is three things. And I want you to keep these in mind as we talk about the consumer. Is one is the first type of person in the plague is one who was very sober and abstemious, which is they kind of are withdrawn and cautious about everything, and they flee in their own way and they stay plague free. The second is the risky, as I'll call them, is those are the ones who indulge in all their cravings, and they go out and they don't care, and they're going to live life to the fullest, even in the middle of the plague. And what they do is they go to all the taverns and ale houses and they enjoy life to whatever it brings and come what may. And then of course there's the third type, and the third type is a blend of the two. I want you to keep in mind as we think about consumers that way. My second story, which is a little bit more sensational around that time, is a murder story that happened during the middle of the plague. And it's around Queen Joanna of Naples, who actually married her Hungarian prince who was in line. The prince, of course, dies mysteriously, and Joanna is blamed. Joanna, who actually had title to the papal lands in Avignon, which is where Pope Clement was. And for everybody in the history, I'll get to the steamy part first, is Joanna and her lover make their way to Avignon in the middle of the plague to go on trial for this murder. And consequently, is Joanna is a great beauty and known very well throughout all of the Renaissance later on as being that. And she charms the Pope, and in a courtroom session, what she does is she basically gets held above all suspicion. Later on, we find out that Joanna actually sold the papal lands at a discount, Avignon, back to the Pope. So the Pope wound up getting a really good deal. So what does this story have to do with the consumer and everything else? Well, we have an election coming, and it's a sensational time that's going to come in this election. And what we've seen so far is some real sensationalism of trying to buy off the public opinion. And that is what we've seen with the Paycheck Protection Program and other stuff, in making sure that consumers hold no fault of their own. So what I'd say to you is this: if you want to answer questions about the consumer, there's a few things that you need to keep in mind. And the first one is this, is that how much government intervention is going to go on in the next 18 months as we see the consumer? The consumer question is going to be, when do I go back to work? Because ultimately the consumer is a worker. The third one will be is, what does the economy look like? And lastly, is the fourth piece that we're going to have here is the virus itself, and this 18-month cycle between treatment, vaccine, and remediation. So with that, I'd like to turn over and actually introduce my panelists. In this case, Gavin Mormon of Foursquare. Can you say a few things about yourself? And then we'll also go to Jeff Schmidt.
Yeah, no problem. Thanks, Rob. That was a good intro there. Good to see you again as well. Gavin from Foursquare. I lead business development, and our company, as Rob mentioned, has a great understanding of how consumers are moving in and about the United States right now. At a high level, we have a panel of 100 million devices, and can cut and slice that data into millions of different ways. It's an SDK source data set, and we can passively track devices in real time. So I can kind of pause there. Are we just doing intros, Rob?
Yeah, we'll do intros and then so Jeff, you want to introduce yourself?
Yeah, hello. My name is Jeff Schmidt, and I run Data Pulse. Data Pulse provides data about names that are of particular interest in a post-COVID world. We've been covering Slack and Zoom and Teams and names like that since, in the case of Slack, since before they went public. And obviously, these data sets are particularly interesting as we observe business behavior in a post-COVID world, and then also as we get to a new normal, sometime later this year and moving forward. What are all the secondary and tertiary knock-on effects, and how do we all go back to work in a new way?
So Gavin, I want to hit you first, only because of the location data and what you guys do at Foursquare, right? And this is the first thing that's on anybody's mind. We're midway through now, the month of April, right? We're hearing whisperings just of, who's going to open, what's going to happen, how does it is in what you're seeing in data and potentially the data or thesis that people come up with. How does Foursquare kind of play into this model of figuring out is like, are we open for business or are we not open for business?
Yeah, no, it's a good question. I mean, what is this, week 4 or 5? I kind of lose track of the days.
I don't know. I'm measuring my calories, so I'm losing track for sure.
I will say the first 2 weeks, kind of like late March, I must have had like 50 calls from investment firms that were just trying to figure out like what is happening out there in the real world. So a couple questions that kind of been like a common theme amongst them was, are people actually listening to shelter in place protocols, right? How are people behaving in, say, Florida versus people in New York versus people in Chicago? That was a common theme. You know, the other one was, we understand that this season, and I've been kind of thinking of it more as a season, because you know, it will eventually end as seasons do. What will that look like kind of on the back end? You know, people talk about the bounce back. Is that a gradual bounce back, or is it, you know, aggressive in certain verticals? So, you know, from a vertical perspective, like how will travel recover relative to restaurants? And, you know, segmenting even further, you know, how are different age groups responding differently, right? So those are just some of the questions that I've been getting from investment firms, and you know, the data that we have can provide insight into that, right? I can share a couple slides right now just to show what we've been seeing from a trends perspective. Let me share here. Okay.
Tim might have to turn sharing off. There you go.
Can you? Yeah, works.
Yep, you're great now. You're good.
So obviously, like as I mentioned, there's, you know, millions of ways to cut this data. What I'm showing here is just, you know, obviously the x-axis is time. We started looking at this, you know, since February 19th, although we do have 4 years of historical visit data, but we kind of focused in on the last 60 days. And this is index foot traffic. So the y-axis is just the index score relative to day one being February 19th. And then looking at regions, national, Midwest, Northeast, South, and West. So generally people are behaving in kind of the same way. And, you know, there's obviously a direct correlation between what people say in the news and then how people respond. You know, so this is looking at just drugstores and pharmacies, obviously a humongous surge in traffic once, you know, after the national emergency was declared on March 13th. Although, you know, what we've been seeing across different categories as well, there's been sort of a leveling off. As people sort of did like a bulk purchase. Similar with convenience stores, sort of a surge in March 18th, and then a steady decline over the last 2 weeks. You know, and a lot of this is like, we're confirming a lot of what already people pretty much thought was happening. Like people are going to grocery stores, people are going to parks when maybe they shouldn't be going to parks. But you know, investment firms are keen on measuring this change, right? Like, is it down 50%, and what is the rate of change between each day? Yeah, this is the grocery slide. So yeah, this one was kind of unsettling. I think that was why I couldn't get most of my stuff, right? Humongous surge, you know, in late March, and then things are kind of settling right now. So, you know, investment firms, you know, want to understand these trends over time because, you know, while we seem to be on the back end of it, there are certain verticals and categories where, you know, peaks and troughs will emerge kind of in the future.
Absolutely. Hey, Jeff, I want to pop to you. You and I had an interesting conversation earlier this week, and one of the things that we talked about was the staggered nature of probably what's going to happen with work. And I know that you have a lot of data that you've been looking at on cloud bandwidth and really what the shift has gone on. I'd be interested to explore that because I think there's a definite setup here between cities and suburbs and what's happening with bandwidth and what's going on, and potentially with staggered returns to work. So why don't you maybe tell us what you've been seeing with that?
Yeah, absolutely. So like I mentioned, you know, Data Pulse covers Slack and Zoom and Teams and all of the names that are of a great amount of interest given the current situation. And you know, like Gavin, we've gotten a whole bunch of inbound requests asking, you know, what's really going on, right? We know people are using Slack and Zoom in greater, you know, degree, but what's really happening? And obviously, you know, all of our charts trend up, and the, you know, the multiples are, you know, we're seeing 30–40% growth in some of these platforms. What's interesting to me is, you know, what's going to happen in the second and third phases of this, right? So we are in the first phase, which is the emergency crisis, everybody, you know, work from home and figure it out phase. That that has generated the increase in utilization of the work from home platforms and, you know, VPNs and everything else. But as we get into the second phase, which is kind of the leveling off, which hopefully we're getting closer to now, we'll probably be there by summer, and we kind of exist in a new normal, but not quite the steady state normal. what's interesting to me and what our data, will give some theses on is what does that look like? Of the 80% of knowledge workers that are working from home now, what percent of them are going back to the office? What percent of them are never going back to the office? That has all kinds of knock-on effects that I think are fascinating. It has effects on real estate. Do you really need to have 30,000 employees in Manhattan or in downtown Chicago? If they can, if during this episode we've shown that they can work effectively from home and over Slack and Teams and such. What sorts of impacts does that have on public transportation? What sorts of impacts does that have on private transportation? This is about the fourth or fifth of these virtual conference sorts of things that I've done, and I'm sure we've all been involved in a couple. And they're very effective. BattleFin has done a great job here, and people, human beings do like to get together and meet at the bar. I've met many people here at the bar, and that's great. But a lot of that work can be accomplished, over a forum like this. That's a lot cheaper. So there's all kinds of knock-on impacts that I really enjoy thinking about, and I hope our data can look at not just the way up, but the way down, how it looks when things get back to normal. Finally, I think I'd be remiss if we didn't comment on the social aspects, particularly of Zoom a little bit. Zoom has become, and I think Rob, you mentioned this when we talked, but a sort of social network. I've done 6 or 7 virtual happy hours. We've got connecting with friends and family in Zoom beer and Diet Coke sessions, and it's just a fascinating dynamic that's emerging from this. And Zoom is their management is smart, and they'll figure out a way to take advantage of that entirely unanticipated use case for their platform, I'm sure.
So if we're looking at a world, just taking the two, where there's still, for the next 18 months, there's a lot of uncertainty about who gets to go back to work, who's essential, who's the non-essential people who get to come back, how knowledge work, basically compares with the rest of the service economy, which we've understood now that delivery, food service, right, and healthcare are the biggest areas, right, that are really taking, as well as industrial. There's a couple of things that I've been looking at just specifically, and just to get your points. If we talk about places to really place your emphasis, right, is no matter what administration is going to be in power, it seems to me, is that whether it's Republican or Democrat, there's a definite shift. And how do we find this from the data? What's going out there is on manufacturing, right? One of the things that I think that everybody's talked about in this case is going to be there will be some type of shift where the United States looks at essential things that they are essential industries and tries to bring that back. How do we tell, in this case, Gavin, are there ways that we can look at through Foursquare with tracking and other stuff about, early site construction or things like that? Or even in your case, Jeff, I'd be interested to hear, who do you think the winners would be in a situation like that? So Gavin, why don't we start with you for about a minute or so, and then we'll go to Jeff.
Yeah, I mean, from a construction standpoint, I mean, our data tends to favor like the more consumer facing verticals, right? Like restaurants, QSR, travel. We're sort of like the leading indicator when those categories start to fluctuate. I mean, I think potentially like the downstream effects of things like on what you mentioned could have a downstream effect on the data that we see. But yeah, maybe Jeff could be a better.
Definitely on the takeout side, I noticed I happen to be living in a new development that's actually under construction, and I noticed that takeout, at least along the local guys and serving, is happening here a lot, right? For the construction workers who are all gainfully employed. Hey Jeff, who do you think in this case, in the migration back of some of these essential industries, what's happening?
Yeah. So, I mean, look, it's hard to do construction over Slack or Zoom, and some things just are going to always be, physical world. Where they happen as going to have a lot of input from policy at this point, in a way that it might not have before. What we see is in the data that we have, some things that we never thought could be done remotely are increasingly being done remotely. I like platforms like the telemedicine uses of Zoom, for example, are just amazing. Doctor visits might go down quite a bit if you can handle what you need to handle over telemedicine. If you look at school, school's occurring over Zoom right now very effectively. That might have a dramatic effect on, particularly post-secondary that's been going towards remote education now for years. So I think watching these, kind of non-obvious second and third derivatives will be really interesting in the next, 2 years.
So back to my point about the three types, right? Do we think that this is still going to be a cautious consumer? Do we think this is going to be a consumer who's going to jump right in? Or is this a middle of the road consumer for the next 18 months where we don't have a direction either way?
I mean, I think,
Gavin, I'll go with you. Which one do you think we got?
so I think if I'm understanding the question correctly, I think it's going to be largely dependent on the risk profile of each person. So for example, like 18 to 24-year-olds are going to be bouncing back a lot faster than say 65 plus.
Gotcha. What do you think,
Yeah.
Jeff?
Yeah, I think that's right. I'll throw in the caveat that I think a lot of 18 to 24-year-olds are never going to go to a physical office again. People that are computer programmers, data scientists, people that in the Gen Z and maybe the younger millennials. I think a lot of them are never going to go to a physical office again after this.
So what you're saying there, in some cases, to me, changes the face of cities as we know them, right? And changes the profile of what we think. So we're going to wrap here. If there's any questions, just in if you want the nota bene on the Queen Joanna story from Naples, she survived the plague. She did pretty well, but it caught up with her in the end. About maybe 20, 30 years later, she was held captive and assassinated. So you never escape your fate, no matter what. In that case, just to let you know. So if there are any questions, I'll take them. Otherwise, we'll Todd, I'll give the con back to you, and you can do the rest.
Yep. Thank you, Rob. We're going to wrap. Once again, if anyone has interesting questions, if they want to email us, info@battlefin.com, we'll make sure to pass them on to the two panelists. Thank you, Jeff. Thank you, Gavin. Thank you, Rob. I've got my history lesson in for the day, so
that's it. You got.
Where'd he go? I think we lost him. Todd was quick on the transition, but great panel. Obviously foot traffic, extremely important for the recovery. Also looking at the Zoom and the various data pulse numbers is going to be interesting coming into this quarter, just to see what's happening. I'm going to share my screen while we transition to the next panel. Maybe Todd as well, while we're doing this, if you could launch that last poll, if it's on there. I think that one of the things that we've looked at is kind of what is going to happen with the workforce. And one question that came up when we were doing our pre-panel call for this one was, if you could work from home going forward and not have to commute or not have to do it, would you take a 20% pay cut to do that? And I thought it was kind of an interesting dynamic, especially maybe it'll be more millennial focused, just because they're maybe used to working from home at the start anyway. But we'll let that poll get started. And while we do that, I will make one quick announcement for the data buyers that are on. Please remember to log into Ensemble, check your one-on-one schedule. So if you go into Ensemble, the one-on-one meetings are up here. These will populate right before the 1 o'clock timeframes. You already see them. The meeting links will populate right before the one-on-one timeframes. But with that, we'll move into the next panel. I wanted to introduce our panelists. We have Toby Dayton from LinkUp, Adam Barron from Refinitiv, and Dr. Richard Peterson from MarketPsych. So Toby, if you could, I'd love to have you give us kind of an intro on yourself, and we'll start with you.
Excellent. Thanks, Tim. So just a little bit of background on LinkUp. So we are the global leader in delivering job market information, and we do that by indexing jobs directly from company websites. So we've got a historical data set that goes back about 10 years, about 130 million job records, again, indexed directly from every day, directly from company websites. So it's accurate real-time information into labor demand.
And why don't we move over to Adam next to give us your background?
Sure. So I'm coming from Refinitiv. You probably recognize us from all the traditional data that's within Ensemble and the Sandbox to help augment the alternative data. My day job is on the StarMine research team, where I look at the combination of the two to create new quantitative finance models.
Great. And over to you, Dr. Richard Peterson. Oh, you're on mute. If we can unmute Richard, I think you're on mute. So there we go. Let's see. I'll try to unmute you from mine.
Okay. Can you hear me now?
Yep.
I think I unmuted, or we both unmuted, which created a mute. So anyway, thanks everyone. So I run MarketPsych Data, which produces news and social media analytics based on obviously the news and social media flow. We look at emotions and themes that are being discussed in the media and create data feeds that are used by, of course, many of the BattleFin clients and clientele. So good to be here.
Great. I'll share the results quickly. Looks like most people, 76% do not want to pay cut, prefer commute. So let's jump into the panel. I think this one's really interesting because what we're trying to do here is also kind of highlight the power of data now, which is, taking you through some of the different ways of using the actual data and how, in this case, jobs data and even news data can really be a leading indicator, and then also, what can we look for in terms of recovery and signs there. So maybe I'll stop sharing, and Toby, if you have anything that you want to put on the screen, we'll start with you, just to get a sense of, what were some of the things that may have been happening in the jobs listing market that preceded this, and then, take us through any areas of strength or kind of nuances that you guys may have picked up.
Yeah, excellent. Thanks. So I'll just run through a couple of quick slides on some of the things that we're tracking closely with our job market data. Let me see here, go to the next slide. So just again, a little bit of background. I covered some of this, but to give you a little bit of context around what we're looking at. So we do index jobs globally every day directly from right now about 60,000 companies. The historical data set goes back 10 plus years, about 130 million job records. Every night it's updated with about 4 million jobs that are updated daily. And then we do a bunch of parsing of those jobs to look at industry information, occupation information, obviously detailed granular looks into what's going on within specific companies and geographies and a whole bunch of information around that. So clearly with what's going on in the world these days, we're tracking labor demand, which has just been obviously decimated, both from a job standpoint and then a future labor demand. And we've seen that really dramatically in our data, not surprisingly at all. So we're tracking a whole pile of different analytics with that. We're just highlight a couple of these. And this data goes up through, I think, earlier this week. So this is really tracking what we started to see beginning in March for about the last 6 weeks. So starting on the upper left, looking at jobs by state, we are definitely an overweight data set for the US. We do index jobs globally, but we're overweight US. And what's interesting too with the data set is looking at global employers and all of the listings they have inside the US. So we get a very accurate sense of what's going on across the entire US economy from employers all over the world. So looking at the data by state, it's really been interesting. Through March, job listings, and again, because job listings are sort of forward looking. We've got kind of a predictive view of what's going on in the job market and what we expect to happen in future periods. So we started to see really dramatic declines right in the middle of March, right about the 16th. You can see, we'll get to it in some of the later graphs here, but it really started to drop just at just unprecedented levels. In March, labor demand as a whole was down about 20%, and that really took place in just the second back half of the month in the last 2 weeks of March. Since then, in April, the declines have continued, and job listings have come down now about 30% across the country. And you can see it at a state level. There's some pretty good variation from state to state in terms of where we're seeing those declines by geography. We track it down to zip code level, so we got pretty granular views into where that labor demand is seeing pretty dramatic changes. Looking at industry in the top right, we track by NAICS codes and a bunch of other sort of sector identifiers. We're looking here at NAICS information. And in March, it was interesting, not surprisingly, as kind of the headlines, everything really started in restaurants and food service as the lockdowns began. Started to see really dramatic declines there. Those have continued. But what's interesting is that retail, while that took started early, it really has become the most impacted industry has really been retail, and that's continued and accelerated actually as things have continued. Healthcare, professional are sort of round out the top 4 in terms of industries. Their manufacturing has seen some declines as well. So we're tracking industry information really closely. Moving to the lower left, one of the analytics that we've created that normalizes our data set to account for the fact that we're always adding new companies is what we call the Link Up 10,000. And that's a daily and a monthly analytic that tracks the labor demand for the 10,000 global employers that have the most job listings inside the US on any given day or any given month. And again, this really highlights how quickly the declines and how severe those declines have been, really beginning in the middle of March. And so we're tracking that as we're looking for, hopefully some kind of bottom here at some point. It continues to decline on a daily basis. And it's something that we think coming out on the backside of this, we'll start to see some either plateauing and then eventually some recovery there. And then lastly, in the right, we do track jobs by country. And so we've just highlighted some of the countries here. There are 6 countries we're tracking in North America and Western Europe, and the patterns are all very similar. We've normalized this to January 1st, looking at those declines, and again, looking at how quick and severe that has really been across all those countries. And then one last slide, we do track the information down to an individual job level. So we've looked at here is just a graph of the declines that we're seeing in most of the cases, some increases in labor demand as well, not surprisingly in certain sectors, particularly in grocery stores, some retailers, drugs, pharmaceuticals, pharmacies. Those kinds of companies are seeing some increases, but for the most part, the declines have obviously been just broad-based throughout the economy. So we're looking here at both the job count as the quantity of job listings that have declined, as well as the percent. And so you can track that. And again, not a lot of surprises on this chart, but interesting to see some of the companies that really have just had massive declines in job listings. Restaurants, the travel industry, airlines. But what's interesting is you start to look at some financials, you look at some professional services companies like Accenture and EY and PwC. So it's really been, I think there's been some pockets here across the economy that have shown how broad and how deep the declines really are. And then looking at just from a straight up company count, the number of companies that really have seen declines. On any given day, we've got about 25,000 companies that have at least one active job in our search engine and in the data set. And so you look at how many companies were taking jobs off of their sites very quickly, and almost 2,000 companies removed every single job opening on their site in March. So again, pretty dramatic impact on labor demand.
Great. And yeah, maybe some things that are popping into my mind are, how are we going to be able to track when that starts to happen again, or just in terms of monitoring those sites and hearing from you, and when they start to recover. Maybe we'll come back to that, and we'll give the sharing capability over to Adam, because I think one of the really great things about even this presentation is, look, there's jobs, indicators. There's also going to need to be some type of fundamental estimates or some type of reference data that's going to be involved to try to figure out, okay, what do you do with that data? And one of the things we've been really excited about at BattleFin is these idea of exploration kits, and taking the data providers' data that we have with, kind of Refinitiv and some of their fundamental and reference data, and building these kits to really show investors how to use the data and get them started. So maybe Adam, you can kind of take us through how it works.
Yeah, sure. So what everyone's seeing right here is the Ensemble Sandbox. It's basically like a Jupyter notebook embedded into BattleFin's platform, and you can pull data from many sources that are already preloaded. Just a little background, in my day job at StarMine, I've been looking at the interplay of traditional data, like the sell side analyst, what they think about various companies, with this more alternative data, the link up job postings. And I'm finding some interesting phenomenon when there's a divergence between the two, when, say, perhaps link up is showing a trend that the analysts haven't quite caught up on. Because of the scope of this demo, I'm only going to highlight one company, kind of like the magic of when Martha Stewart puts in a raw turkey and a minute later it's cooked. This is like the result of searching around for some interesting results. So just a quick background, we heard a lot about retail being affected negatively, but not all retail is the same. There's this company Farfetch, which some of you may know. If you're in the market for a $675 Valentino wallet, this is the place to get it. This is a result of some work that I've done with a colleague of mine, Jerome Martis, on a research piece on Lipper Alpha about trends in retail right now. So let's dive into Farfetch a bit. So just a quick thing, in BattleFin, you can see all the data sets you're entitled to. You'll see there's tons of Refinitiv stuff here, including the IBES estimates and tons of link up. The way to pull, the link up data is pretty easy. You just do a get. I'm going to be focusing on one ticker right now, and the data kind of looks pretty straightforward. It's a daily time series. You have the created and deleted jobs. So what I like the most are the number of active jobs on a given day, because this is more consistent than the jumpy created, deleted, but they could be useful for other purposes. And then IBES is something that we at Refinitiv, it's one of our top sellers. We've been selling it for quite some time. It's here to try in the Ensemble platform. So these are the consensus estimates, equal weighted estimates of what the analysts feel certain financials will be when they're released. So we're going to look at revenue for the next quarter, and in this case, it's the quarter ending in March. Well, that ended at the end of March, but as you know, these quarterly reports usually are delayed, maybe 45 days, but even more now that the SEC has allowed companies to delay their reporting during the COVID crisis. So it's even more important to really see what the analysts are saying. Do a little magic here just to smooth out the data a bit, and for the plot. So in green are the active jobs from LinkUp, and as with all retail, there was this precipitous decline. I think, probably January, actually, almost going near zero and staying there. That's not really surprising. I mean, nowadays, that's not what we're looking for. Retail or airlines or cruise jobs declining is nothing new. But what happened was, towards the end of March, there was this big jump in job postings right here. from near zero to 340. Meanwhile, the analysts have been revising down consistently, though. And these are $1 million scale. So granted, it's not huge, but it's still been a decline. So, what's interesting here is what picture aren't the analysts thinking about? And there is data also in Ensemble is data about the actual job postings. Going to save us time and just get to the point that it was kind of data scientists, artificial intelligence, machine learning engineers, and just other technical jobs that have really increased. So perhaps that's an indication that Farfetch is bullish about their future, so much so they're investing in talent, perhaps at a time when it's a buyer's market to get that type of talent, when so many other companies are, slashing job postings and laying off. So that's, that's this one company highlighted, but there's so much more if you work with, work with our two data sets together to find these interesting stories that are a little counterintuitive to what you think about the overall industry's trends. Because within the industry, there are some really interesting stories that don't follow the general narrative.
Great. Why don't we turn it over to the market site perspective? I've heard you say a couple times or picked up from some of the webinars, you're trying to digitize cognitive biases. And I'd want if you could explain that comment that, comment that panic is more intense than fear. That was struck me as very interesting. And then maybe even if you want to go in through some of the slides, because that was something I've been thinking about a lot.
Yeah, thanks, Tim. So, they say Wall Street climbs a wall of worry, right? But we should buy on fear. So the general idea is low-level fear gets people to pay attention. And usually when people pay attention, they're more likely to take risk, actually. A little bit of fear isn't enough to stop them. But when it starts to cascade into panic, they go overboard and things crash down. But when that panic ends, you get a nice big bounce. And so I'll show a couple slides on that. And I'll explain where I'm coming from too, of course. So thanks for the intro, Tim. So we do look at biases in the sense that we look at emotions, and a lot of investor emotions we can now see in the media, in social media, when people say they're worried or they're being more cautious these days, or in news media when it's sort of a third-party reporting about investors are scared and there's fear in the markets. So when we quantify emotions and also some themes, we can see patterns. Of course, investors like Warren Buffett, the wealthiest guy in the world at some points in history, has said he buys on fear and sells on greed. So you can test that with this type of data set. So the data that I'm talking about, there's two data sets. We have the first one on the Ensemble, and we have some Jupyter notebooks like Adam showed, where you can test some of the strategies that I will show you next in the subsequent slides. But I'll give you a little background of what this data is, because it's not that straightforward. So big picture is, we're ingesting 2,000 global news sources, 800 financial media sites. We ingest articles within minutes, usually with 2 to 3 minutes of when they're published. And we're translating them via text analytics in a few milliseconds into a digitized stream. So you can see how positive people are speaking about a given company, or how much fear they have about the US stock market or the Chinese stock market. You can look at tens of thousands of assets. We have here listed a few of them. And we do have a 5-year data set in Ensemble. And what we're seeing in this data, and what you can test in Ensemble, is questions like, does the media, fear in the media, lead prices down, or does it indicate there's a bottom? And how does that work? And if very successful traders like Warren Buffett or George Soros talk about psychology affecting prices, we should be able to test that. And so that's what we've tried to set up. Now, the second product you see on the page is the StarMine Market Psych Media Sentiment Model, which we launched last month with the StarMine team. And this model was created to essentially create a simplified predictive signal based on all of these indexes that we track in the media. And it tries to predict out 30 days. It turns out it's predicted even farther than that in our testing. But it can predict out about 30 days. And we look at the spread between the 10% of stocks that are ranked the most positive on this rating versus the 10% that are the most negative. And we see over a 10% average annual return. And what's really interesting this year is we productized this. We actually finished it over a year ago. And we finalized it with StarMine back in August. And since the beginning of this year, it's been having a 16% average annualized spread between the top and bottom decile of all US stocks. So it's 4,000 US stocks. You're talking like 400 versus bottom 400. So there's a nice big sentiment spread in the market, and it's getting wider now. It's even bigger than we would have expected. So obviously volatility helps that. So the general pattern, and so I flipped forward a slide, the general pattern that we see is something you can see here with this Apple chart. So starting back in 2018, you can see that this Apple share price is in yellow bars, and there are two moving averages of media sentiment. So sentiment is all the positive impressions about the company versus all the negative mentions of the company. Essentially, that's the balance you see. And we put two moving averages here so you can see when they cross. And one of our clients told us that when sentiment becomes more negative, they usually see that as a good time to go risk off. And this is Apple. We also see this with, of course, major stock indexes, but Apple was one of the first companies to warn and really spook the markets about the slowdown in their retail sales coming from China. So you see all the way back in 2018, this one effect where negative sentiment came into the markets, Apple share price seemed to follow it down. We had a false alarm. In some cases, sentiment follows the price rather than leads the price. So we have to be careful of that. That's what happened here. And then more recently, we see again, sentiment fell, and then we had the big collapse around coronavirus. So we do tend to see that media turns more negative. And I do wonder, looking at the linked up data, how much media predicts whether hiring managers will withdraw jobs, or whether media, I think we have a good risk off signal here. But what we don't have is the type of risk on signal necessarily, which is what Adam was showing. So on the one hand, you can see that media negativity spooks people and they pull out of taking risk, like stock prices. But to find a bottom, often the media is slow. As you can see, they don't catch the bottom very well. But what seems to catch the bottom may be more something like employment data, job openings. So I think that's what Adam was suggesting. That's quite interesting. So here are those turning points. Now, I mentioned we have two types of data. So this is our predictive data here, and we looked through this, similar to Adam. We went through a bunch of data to find some interesting turkey to pull it straight out of the oven, fully baked. This is a company that manufactures ventilators and fancy hospital beds, and it is called Hillrom Holdings. It's about a $7 billion company that most people have never heard of. On our ranking, back in mid-February, it went up quite high because of interest in this company due to the coronavirus. And this was picked up in the media early. You can see it actually underperformed for a while. The red line here is the S&P 500. The black line is the share price. And the blue line is the score on our sentiment ranking. And higher scores indicate the price is more likely to outperform its peers. And so in this case, we see a much higher score on our StarMine market cycle model. And we do see significant outperformance coming out of the crisis. What was interesting, though, again, is that this was picked up early. The thought that this company would outperform was picked up in the media early on as investors were talking about the need for ventilators and the fact that this company makes ventilators. So by doing this big data analytics, we can pull this out of the media quite easily. And then there it is again. Lastly is this idea that maybe fear can help us call the bottom. Now, I prefer what Adam is doing and what Toby are doing in terms of timing a bottom precisely. But we do see that with our data, there are some fear-related bounces. We do see this consistently over thousands of stocks for 20 years that we have this data set. We see consistent fear-related bounces. Now, what I'm showing in this chart is a stock price chart of the S&P 500 in the blue line. And these red bars here in the background reflect higher than average fear. So when fear in the markets is higher than average, you get this red line. And you can see fear was all the way back in January. And it actually correlated pretty well with the coronavirus being mentioned in the media, in the Chinese media, and then more in the US media later on. And this is a two moving averages of fear. And you can see fear rising, which is telling us that this is potential risk off situation. And sure enough, the market collapses. And now, though, we see fear actually retreating quite a bit. And there's actually a funny study that some academics did where they subjected subjects to electric shocks. And so speaking of biases, Tim, you can imagine if you're being faced with an electric shock, you might be a little biased about what you do next. So what they set up was a question: would you take this financial risk on a coin flip, or would you rather take guaranteed money if we, were in a situation where they were going to shock them. And they said, if you lose the coin flip, you'll be shocked. If you win, you make a lot of money, or you can have 10 cents and you can leave the experiment. But they found in these conditions that when they withdrew the electric shock and they offered people the coin flip, all of them would go for it. And they would take really big risks, even ones that were irrational. So the point is, when we have a lot of risk or a lot of fear, and the fear withdraws or it starts to simmer down, people rush back into the markets. And that's why you see these relief rallies, these really big bounces. So according to this data, it looks like we did have that. And fortunately, in the ensemble, you can test some of these strategies. Specifically, the one I showed at first with Apple, we have this set up for crude oil and the whole US stock market. We've been having this on ensemble since last September. And we show a crude oil strategy there that again predicted the downturn in crude oil this year. So I do suggest, if you're interested in energy markets or global macro type forecasting, to check out the Market Psych Ensemble Toolkit, which would allow you to create some of these models and see that even in forward testing, these things have been very accurate. Though on the bottom question, I think Adam and Toby have a lot to offer as well. So thanks.
Yeah, thanks. We looked at the electric shock stimulants for BattleFin, and Todd said no, we couldn't do it. So we've gone away from that. But I think it's interesting what you're kind of highlighting. The market has had this 25% bounce back, due to outlook on the coronavirus getting better, massive monetary and fiscal stimulus, and kind of stabilizing oil prices. I think one of the things that we've been trying to focus on as well is, okay, is there a risk of a second wave? And how do you predict that? And this kind of gets to one of the questions on the from the audience for Toby. Based on your data and job demand, is there anything in China that you're seeing that would help with that, help to understand either more of a recovery or any type of second wave, or is it too early to kind of predict that? I guess would be the first question.
It is. It is interesting, and I think that is something we're tracking really closely. Unfortunately, our data set in China is not significant enough to have a really high confidence factor in what we're seeing there. It's on selective companies, so it's hard to draw larger conclusions about what we're seeing in China. But in the US for sure, and in some other more developed countries in Europe, that is something we are tracking really closely, is what we expect to see in sort of subsequent waves over time, and where we might start to see some signs of recovery for sure. It's really and having gone through this, we've been in the job market data business for a long time. We saw this going into and out of the Great Recession, 10 plus years ago. So back then it was the earliest signs as the economy started to thaw out and recover. We started to see some very, very early signs in transportation in particular, ports and long haul trucking, and some things as the economy started to finally get back going again. And actually that we started to see that well before that was showing up in other kinds of data, that traditional market data, that and signs, that official data that people were looking at. So it can be quite predictive, looking at labor demand in a lot of ways, going back to the sort of emotion and fear and panic for businesses. Job listings are a really good window into the sort of psyche of companies and how they're thinking about their businesses. And that fear index at a consumer level is very applicable to the business level, and it shows up in job listings. So we're certainly watching closely by sector and geography and companies, individual companies, for when that fear starts to subside and businesses start to feel confident again in hiring.
Yeah, and I think a lot of, and some of the earlier panels we talked about, in the volatility panel, it was looking at, the financial crisis of 2008, maybe it was 2001 as well. Just looking at some of the jobs data, and I think it was on one of the slides, like who were some of the bigger winners, and is that continuing? And I guess, you just mentioned transportation, like, I wonder, back in 2008, was that just a totally different, aspect, because you really didn't have the stay-at-home aspect, or any other trends or positives of winners that you guys have seen from the jobs data?
Yeah, I think we'll see if this time is different. I think there are some things that are quite unique to this that are different from the Great Recession and coming out of that. And we did have a period of jobless recovery for quite some time. I think the big question now is this going to be a V or a U-shaped kind of recovery, and how quick is it going to happen? I think that's where some of the sort of second waves, that are going to start to ripple through, that I think are going to be part of that answer. In terms of winners, other than some of the obvious ones, and we highlighted a couple of the companies this time, and some of the groceries and food companies and those areas, I think as the things get lifted and people start to get back to some semblance of, at least maybe not normal, but out of this current phase we're in, starting to see where those are going to start to manifest themselves in the broader economy is something we're obviously tracking closely.
Gotcha. Adam, anything else on the, I know you mentioned like the 45-day delay or potential that companies can delay earnings. It would seem like now is kind of a more important time than ever for alternative data, just because you can get these other sources. Is the analyst, I'd almost wonder if the analyst community is perplexed. I can't imagine they're getting a lot of calls returned. And I guess, can you just you have IBIS estimates, and then you have, I think there's another product that drills down into the, ranking some of the analysts. Can you just talk about that for a second, and also any earnings related things that you guys are picking up?
Yeah, sure. So yeah, I mean, it's the 45 delay is kind of the traditional reporting delay about when the period ends and usually when they release the numbers. But now there's an additional delay by the SEC for companies that are affected by the coronavirus, which I think many of them are going to take that delay. So the analysts are more important than ever. And, I think the human analysts are still a really strong baseline. We have that product you're mentioning was our StarMine Smart Estimates. It's one of the very first StarMine products. We give a star rating 1 through 5, 5 being the best, to analysts based on how good their predictions are relative to their peers, hence the star and StarMine. And then we create a star weighted average instead of an equal weighted average to, basically show, basically give more weight to the experts. And then from that, there's something called predicted surprise, which is the difference between the experts and the herd. So that's also, that's not an ensemble, but talk to anyone at Refinitiv, we'd be happy to tell you more about that. That's a really good way to, from all the analysts, maybe focus on the ones that are doing a good job. I mean, all of us are struggling right now with the whole work from home dynamic, but there are some people that are thriving in the silent, kind of in the quiet, away from the office, and doing a really good job. And you'll see that within the analysts, that, the 5-star analysts are doing a really good job there, though they may not have access to all the alternative data, which is kind of the point of what I showed earlier, that it's really the marriage of the traditional data and the alternative data that can give you the best knowledge to approach these markets. And, personally, I think it's really hard to predict the turnaround, but if you, within companies, across companies, within industries, you can still sort them between who you think the winners will be. And that's really the power there of combining the two, even if you can't venture when this whole thing will turn around.
Great. I guess the last question to Dr. Peterson. In the event we have a second wave, what would you expect to see in your data, or how would you think that market psych would pick up on this? Is there a way of trying to think through that, if there's a second wave or a third wave or anything like that?
Yeah, so Tim, we see that sentiment is of course really low right now, but obviously prices are going up. And I would imagine though that even from this low level, it could go lower, that things can roll over again in another stage. So I think we'll see in the media if there's more concern about the outbreak and how it affects companies, or as we get to earnings season, if you see a lot more profit warnings. In our case, you can see that on the individual company level, but you can also aggregate it up into the whole stock index level. And so I'll be looking for a risk-off signal for the entire S&P 500 based on the entirety of the news flow. Because like Toby was pointing out about job listings, there is a feeling in the media that affects people unconsciously. And we know that from the bias research and behavioral finance. People are affected by their environment. And when there's a lot of negative news flowing through, it changes how people think about taking risk. They take less risk. There's fewer people to buy, more people selling. And so then you end up getting the downturn continuing. Right now, of course, the fear was low, though the overall sentiment is quite negative because there's a lot of deaths. So I would look for fear to start rising again, and I would look for another downturn in the sentiment, a second leg down.
Hopefully it doesn't happen, but at least
I hope it doesn't happen. Yeah,
we have
exactly.
the data to hopefully alert us if it
Yeah.
does. But great. Well, thank you guys. We appreciate the time and the insights. Hopefully we'll be participating in the one-on-ones this afternoon. Final reminder to the buyers and providers to log in, hit refresh, Control R, see if any of your schedules have updated. The links won't actually go green until prior to the start times. So just one thing to be aware of. And if you have any problems, email us at support@battlefin.com. And that's a wrap for our first virtual Discovery Day. And thank you guys, and we'll hope to meet up again soon.
Thanks, Tim. Thanks, everyone.
Fantastic. Thank you, everybody.
You guys.